here. We're going to hear that. So we do have the first dedicated soy crush plant coming online this fall for North Dakota. So we did ask Jeff to come be with us this morning to give us an update heading into that first season of the Spiritwood facility taking soybeans. So he's going to do that. And then finally, you'll hear from Mark Ewens, meteorologist at KNOX, regarding a weather outlook for the rest of the growing season. So again, housekeeping, I'm still letting some people in here from the waiting room. So if you didn't hear me before, we ask that you keep your mic muted and video off unless you have a question. If you do have a question, we ask that you either use the hand raise function or the chat function, and we can call on that. We will stop for questions several times throughout the webinar today. If you have any technical issues, you can send me a message via the chat. I will keep an eye on that. You can also send me an email. I emailed you all yesterday morning. So with that, I'm going to turn it over to someone probably most of you have heard from before, Dr. Frayne Olson. Frayne, I'm going to spotlight you. There we go. And with that, I'll have you share your screen and we will get started.
All right, very good. Thank you, Jenna. Let me start my screen share. Okay, just double checking that everybody can see that okay?
Looks good to me.
All right, excellent. Well, good morning, everybody. Thank you for joining us today. As Jenna said, I'm Frayne Olson. I'm the crop economist and marketing specialist here at NDSU Extension. So I have two basic components that I want to talk to you about a little bit, different perspectives on looking at pricing and price movements. What are some of the things that market traders and analysts right now are looking at? What are they talking about? What are they most concerned about? We're going to focus and highlight specifically on soybeans. I suspect there might be a few questions on corn as well, which I will try and cover if any questions come up. So here's my contact information. Again, if you have anything, if you think of some questions later on, don't hesitate to try and reach out and contact me, or you can work through the Soybean Council and Jenna, and we can do some follow-up discussions if you wish. The other thing is I have shared all of my slides, so if you do want a copy of this, I have no problem, and I know Jenna has a copy of it, and she can share that with you as well. So my goal right now, this first section, we're going to look at fundamental analysis, which is really the supply and demand conditions. These are things that we're typically very familiar with within agriculture. Obviously, the size of the crop, how quickly exports are increasing, or what's happening in the global markets, as well as what's happening domestically, all have an impact on what pricing is and how we try and distribute our production throughout the marketing year. So I'm going to focus first on the fundamentals, the supply-demand stuff. I'll take a short break for questions to make sure that we cover everything that people want to discuss or have issues about. And then I'm going to transition into the technical analysis portion of it. And we'll look at a little bit more shorter term at kind of price movements, price dynamics. Are there certain trends or certain patterns that we can be looking for in the historical price movements that might give us an additional signal or some additional information about what might be happening next? So with that as an introduction, let's just dive right in. I usually start, if you've heard me before, with the USDA information. Part of that is that I get two rationale. Number one, that really becomes the reference point for a lot of the discussion and analysis and things that go on. So if you're listening to other market analysts or again, reporters, or you're reading something in the news, you're listening to something on the radio, oftentimes the reference point will be say, well, USDA is reporting this, and here's why I think that number is wrong, or why I think this number should be adjusted. And so that becomes kind of that common reference point, that common starting point for saying, well, should we be above or below, and what do you think is going to happen next? So without at least a general understanding of what those numbers are, it's pretty hard to say, well, do I agree with that analysis or assessment or not? Now, obviously, every month, USDA does update this information. So I'm going to explain this table very quickly for those that aren't familiar with it. The column on the far right-hand side is the information for what we call new crops. So this is the crop that's growing in the field right now. It's the crop that was currently going through flowering and pod set. So almost all of the numbers on this table are forecasted numbers. I'll go through some numbers that are actually survey reports. The column in the middle in blue, highlighted in blue, is for old crop. So that's the crop that was harvested last year. We're ending the marketing year now for corn and soybeans. Corn and soybean marketing year starts on September 1. So as of the end of August, starting on September 1, the column in blue, well, all those numbers will be finalized and then kind of basically cast in stone, and we'll keep moving forward on what we consider the new crop. And the reason that USDA uses a marketing year, which is a 12-month period, is that marketing year usually starts just before harvest. And there's a specific reason for that I'll go through in a second. And then the column on the far left-hand side in green is from 2 years ago. And again, we're going to use that kind of as a reference point, as a jumping off point to say, well, how are we doing today relative to some historical numbers? So the top half of this table refers primarily to the production, the inflow of grain. The bottom half focuses really on the outflow or the consumption of grain. And the very bottom line, that ending stocks number, is either an actual number or an estimated number, forecasted number, if you will, for how much grain are we going to have in inventory just before harvest of next year. So I'm going to go through a few numbers, talk about some of the things that the market analysts and traders are focused on right now, and saying, well, how might these numbers adjust? The other thing I want you to do, and we'll talk about this in more detail in a moment, is make sure that you're paying attention, because August 11th, this coming Friday at 11 o'clock a.m. exactly, USDA is going to update their information in red. So that July column in red on the far right-hand side is going to be updated. The significance, the reason that becomes important for the July report, is the July number is the first month where USDA, the NAS, National Agricultural Statistics Service, will use farmer-based surveys as well as satellite imagery, or what they call remote sensing, to be able to update their yield forecasts. Okay, and I'll talk about why that's significant and what some of the things that we'll be expecting to see as we move forward in time. So let's just dive in some of the numbers. I'm not going to spend a lot of time on this, but I do want to take a half a step back to say, let's recap kind of some of the things that we have seen in the markets, the reason we're seeing this tremendous volatility in soybean prices in particular, and why, in my opinion, I think that volatility will continue for a while yet. So first, in June, the June acreage survey, which came out at the very end of June, was, again, a farmer-based survey, about 63, almost 64,000 farmers across the United States, to say, what did you actually plant? It's a follow-up survey to the March report, that March prospective plantings report, on which really asks the question, so what are you intending to seed, or what are you intending to plant? The June report is the follow-up to that prospective plantings, and say, what did you actually seed? And there were some adjustments. And corn and soybeans were the big shock value. So we had a larger increase in corn acreage and a larger decrease in soybean acreage, planted acreage, than we had first expected. In fact, they lost about 4 million acres. And so in a few moments, I'm going to show you kind of this price volatility and price trends. We were on a downward price trend because everybody's expecting about 88 million acres of seeding. And then you put in a trend line yield, or an average yield across the U.S., and it was looking like we were going to have plenty, very adequate supplies of soybeans in the U.S. And you add on top of that the large crop coming out of Brazil this last year. And it looked like the world was going to have plenty of soybeans around, and prices started to slip and fall. Well, this was the shock value that really started that rally or recovery in prices, and kind of had the reset button on, well, where should prices be, and how much supply are we actually have here in the United States? Now, in July, there was also a slight reduction in the the national average yield was unchanged. There were a few people that were expecting a slight reduction. So usually right now at this time of year, we're using trendline yield, which I'll show you in just a minute. But USDA does have the authority, or kind of the ability to adjust the trendline yield up or down slightly, depending upon planting progress, how quickly the crop was planted, as well as kind of early development. Obviously, when the soybean crop or the corn crop is really small, when it's just in its vegetative growth stage, it's really, really difficult to get a handle on what yield potential might be. And so they have the ability to be able to adjust up or down that trend line yield a little bit, but it usually doesn't change very much. And that's why, again, this August report really becomes a critical number, because that's the first month where we're going to start to get a better handle on what does the reproductive stages look like, What is the crop health at this stage of development? We can start counting at least pods. We don't know how many seeds per pod there will be. We'll have a pretty good idea of what the flowering progress is, etc. So it becomes a lot easier to at least make some rough estimates, some early estimates of what yield and yield potential are. So that's why this August report coming out on Friday, they're not only update again this supply and demand numbers, but the NASS, the ag statistics people, will update their yield forecasts as well. So again, looking at trend line yield, I just wanted to give everybody an idea of what's happened. The red line that bounces around is the national average yield for soybeans as reported by NASS. And then the blue line that runs through the middle is the trend line. Okay, so the trend line is essentially, think of it as the average yield that's been adjusted for better farming practices or for technology. Yes, a lot of that is due to genetics, but there's also been significant improvement in just general farm technology and our ability to be able to produce crops. We're able to have larger machinery. We're planting faster, harvesting faster. Precision agriculture is definitely adding the yield stability to some of our varieties. We've got better disease recognition, et cetera. So this cumulative effect of just better farming practices, on average, our yields are starting to go up every year. And so this blue line adjusts for that. Now, as I said earlier, this is the straight trend line. So if you just take the straight numbers, go across the board and say, well, what would that number look like? You'll notice that the dotted line on the far right-hand side is the current USDA forecast at 52 bushels. So I said earlier, early in the season, what they're going to do based on planting progress and general weather conditions, they'll adjust this trend line up or down a little bit based on growing conditions. But we really don't have any major reasons to move off of what is this average yield until, again, this August report. Okay, so what was the net result? We had a pretty dramatic decrease in planted acreage. We had a slight adjustment or basically no adjustment, I guess, in the yield forecasts. So the result was we actually had about a decrease of 210 million bushels in the projection for total production. Now, that was from the June to July estimates. Now, in August, we don't expect any adjustments for the planted or the harvested acreage numbers, but I know that there will be some adjustment to the yield numbers. Right now, the general expectation is that number will drop slightly. The big question is how much, and that's going to be hotly debated. And I'm going to show you some maps and some general information in a minute to try and give you an idea, some reference points on what that might look like. So one of the things we always listen to, and I know you've probably been tired of hearing about, is these crop condition reports. So again, every week USDA puts out a crop condition rating. It's a subjective rating, so I want to be cautious that we put this in the proper context. This is a subjective rating. They do have criteria. There is a description of what does the term good mean? What does that represent? What does the term fair mean? Okay, and so there's trying to get some consistency across states, across reporting districts. So typically what happens is a representative either from the Extension Service or one of the FSA offices or one of the USDA representatives in a county will go around the county, or they'll call the farmers and say, what do you consider the crop condition in this county? All that information on a weekly basis is then set into DC. It's compiled, and then we come up with this, what percentage of the crop or crop conditions fall within these different categories. Now, even though this is a subjective rating, you know, I have some colleagues of mine that actually try and do yield forecasting based off of these reports. They rerun the models every week to say, well, given the new information, let's try and refine our forecast for what the yield might be. And even though I'm not a really big fan of that personally, they feel that it does do a reasonably good job of representing, you know, kind of what general conditions are, and it does give us an idea of where we're sitting. And so I did want to throw this up, and I'm going to show you just a couple things to look at. And you can, this is public information. You can look at it and follow it every week if you wish. So this is the 18 states. These are the major 18 states that plant soybeans. That accounts for about 95%. If you notice up here, 95% of the total soybean bushels produced in the United States is these 18 states. Now, this is, again, just a simple average, okay? So it's not necessarily weighted by Iowa and Illinois having more acres and more production. But if we look at this, there's about 45% is rated good and about 9% excellent this year, this last week. This came out as of Monday. if we look at what's happened to the previous week, and this is something that I do follow fairly closely, is so what's happening to the crop? Let's go from week to week to week. Is the crop getting better? Is it getting worse? Is it about stable? You know, we had a slight increase in some of the good to excellent rating, but relatively minor. Okay, again, this is a subjective basis assessment, and so we don't want to put too much pressure on that. But I do want to look at what's going on between this week relative to the same week last year. So as of last year, we had about 59, almost 60% of the crop was rated good to excellent. Right now, we have about 56%, 54%, excuse me, doing my math right, 54%. So we're a little bit below what we were last year at this time. But again, we've got some growing conditions left, and we've got from a yield potential standpoint, we're really moving into this key reproductive stage. Not only flowering, we're starting into pod set now and seed development. And so obviously temperature as well as moisture conditions are going to have a big indicator. So when we look at this year relative to last year, we're in a very similar place in our ratings, but we're a little bit behind where we saw last year. Just as a reminder, geographically, I do want to show you just for a mental picture that soybeans are growing, you know, the major areas is those 18 states. What this is a map of the 2022 production numbers. So again, we're counting bushels produced. The darker the green, the more bushels are produced in that county. Now, those white little dots you see, even though they're not reported, that there are soybeans planted in those counties, especially here when you get into southern Minnesota, even parts of Illinois. What's happening there, that's a statistical thing. USDA needs to have a minimum number of either acres and or of farmers represented from that county to be able to report it. There wasn't enough information from those particular counties to report a formal yield number or total production number, and so those were left blank. They're missing data points, if you will. But just to give you a general idea, one of the things that I want to remind everybody is the amount of soybean that's produced in this Mississippi River Valley. So a lot of times we think about the Corn Belt, we think about especially Illinois and getting to southern Illinois, and then we can just kind of stop. We really don't focus as much into this Mississippi River Valley because that does produce a lot of soy and soy production, and a lot of that does end up going into the Louisiana Gulf market and not necessarily being used into the crush market. So there's a natural draw or flow of grain into that Louisiana Gulf region into for the export market specifically. But obviously a majority of the soybeans are in this northwest growing region, including North Dakota, eastern South Dakota, southern Minnesota. Obviously Iowa, Illinois, Indiana, Ohio are major soybean producing regions. We get into eastern Nebraska. You also get into southern and central Wisconsin and into the thumb area here into Michigan. Those are really some key soybean producing areas. So I just want to zero in kind of on these areas as we look at the drought monitor map. This came up as of Thursday last week. Now, I personally have, you know, this is an important piece of information. It is followed very closely by a lot of market analysts. It's a very nice visual representation of what's going on with soil moisture conditions. The challenge, and I guess the caution that I have a little bit with using this information, is that the drought monitor map really looks at the entire soil profile. So it's really looking at, you know, what's the dryness of the soil within the entire soil profile, not just the root zone that we have. Okay, so it is possible, and we saw this last year in lots of major parts of North Dakota, where we had very severe drought conditions. But if you get a shot of rain that comes through at the right time, and you can refill that top soil moisture layer, especially with that root zone, you can still, have a reasonable crop. And so even though this is a generalization, it is something that we can follow. I don't want to, again, put too much pressure on this drought monitor map, but it does influence market psychology. And so we can't ignore it. I'm not saying we should ignore it, but I do want to say let's use it appropriately and use the information correctly. Now, the Drought Mitigation Center out of the University of Nebraska also puts together a vegetative drought response index. Now, I've started kind of using this as a representation of general crop conditions. So we're using this NDVI, this vegetative health index, which is really satellite imagery where it goes over and takes a snapshot and says, how green is the crop? Or how green is the vegetation? Now, this particular vegetative condition, it's an index. So we're looking at the greenness or health of the crop, not necessarily at a specific point in time, but we're looking at it saying, well, what will we normally see at this time of year? So we're comparing today's visualization versus what kind of greenness would we normally see. Now, this is an index, so it's actually accumulating this greenness maps over time. So we're starting during the planting season and we're moving all the way through the crop development, because obviously sometimes in the early crop development, we can have some stresses, and then later on, some of those stresses are relieved that might have some influence on yield and yield potential. So it's an index, so it's a kind of a value relative to normal, but it's accumulated. So it's not just a point in time, but it's looking at it of adding all this stuff over time and saying, well, have we seen stress now, but also have we seen stress in the crop earlier? Now, this is for all, this is called the complete map, which includes not only the crop areas, but also the pasture areas and some forest land. So we have to put this again in context. I do want to show you the areas that are of greatest concern. Obviously, as we get into eastern Nebraska, eastern Nebraska, Iowa, Illinois, northern Missouri, which is really where most of the corn and soybeans are. We've got a pocket in here that has had some real stressed crop, not only for corn, but also for soybeans throughout the growing season. We're also seeing this pocket in southwest Minnesota showing up. And I know our friends up here in northeast North Dakota are also feeling the effects of some of this accumulated dryness that we've seen throughout the growing season. So this is a really quick visualization. It's an index. I want to be again cautious about how people interpret this, but we're looking at the accumulated greenness throughout the growing season. So we've seen some of these areas have continued stress. I want to show you two more maps with soil moisture, just to give you, again, some reference points of where we're seeing this stress showing up and what does this mean now as we move into the final crop development and into the yield, really determining the yield at the end of this growing season. This is, again, a computer satellite imagery. This is mathematically calculated on the soil moisture content, and this would be in the top 3 feet of soil. So again, it's computer-generated estimates, but they've been between USDA and NASA. They've been doing this for almost 20 years now, and so they're starting to calibrate the numbers to be reasonably accurate. And it's a good, in my opinion, a pretty good representation. So it's an estimate of the soil moisture in the top 3 feet, which would be about the root zone. Okay, so this would be where the crop is drawing most of its moisture versus the drought monitor map looks at the entire soil profile. And what we're looking at here is the soil anomaly. So this is how are we doing today relative to what we would normally see at this time of year. So let's think about Iowa for a minute. Let me go to the next slide, because this is the absolute number. So if we start saying, what's the volumetric? How much volume of water is in the soil right now? You'd say, well, let's look at Iowa and Illinois and even northern Missouri. They look pretty good in absolute terms. But if we were to go back into relative terms, those areas usually have much more rainfall. So even for those areas, even though they look very green and lush, they are still behind what they would normally see at this time of year. So again, this is the areas that we're looking at in my language, and again, thinking about northern plains agriculture. These are the areas that, yes, they're doing okay. They're kind of hanging in there, but they need to have continued rainfall to be able to finally finish off that crop and be able to get to the end and get to the finish line and have the kinds of yields that we normally expect to come out of the Corn Belt. So the interpretation, the message I'm trying to send is, yeah, they're sitting okay right now. They've had some short-term relief, and I'll show you that in just a moment. But you know what? They're still, I wouldn't say living rain shower to rain shower, but they're going to need to continue to have some continued rain showers, some continued good weather, not only from a temperature standpoint, but from a rainfall standpoint, to be able to finish this crop. And I think get the kinds of yields that right now a lot of people are anticipating might be in the marketplace. So let's go to the precipitation amount. I don't want to steal any thunder from Mark Ewens. He's going to be looking forward and saying, well, what do we expect to see as we go through the rest of the growing season. I did want to show that we had a nice rally going on in the soybean market. A lot of that was driven by concerns about yield and yield potential. Again, because of these drier conditions, because of the hot temperatures in particular that we saw in that central corn belt, the Nebraska through Ohio region. But we did get some rain showers. So this is a map from the National Weather Service. This is the accumulated precipitation amounts. This is the amount of rainfall that's fallen over the last week. And you can see some of those areas that are really in the driest regions, those areas that we were most concerned about as we get into eastern Nebraska, as we get into southwest Iowa, into northern Missouri, we even get into parts of central Illinois. You know, these areas did get some really nice rainfall over the last about 7 days. So one of the reasons we're starting to see again this softening now of prices is that we're taking some of that risk premium back out of the marketplace. People are breathing a little bit easier. You know, when you start to get 3, 4, 5 inches of rainfall and you got some good heavy soil, a lot of people are thinking, well, this should be enough moisture now to be able to finish that soybean crop off and hopefully get us to the end. I don't know if that'll happen. We're going to have to wait to see, and I'm going to be hanging on every word that Mark Ewens says as we move forward to see, in particular, what the temperatures might be and what kind of evapotranspiration rates we're going to have. So one of the other things that happens just before the WASDE report comes out is there's a survey. Reuters does this, Bloomberg does this, Dow Jones often will do a survey of market analysts and trading companies and saying, look, what do you expect USDA's number to be? There's kind of two ways of phrasing this is what do you think as a forecaster or as a particular company that the yield number will be? What is your private forecast? What is your number versus what do you think the USDA number will be? Now, this question, the numbers that you see on this table are really the response to what do you think the USDA number will be? And the reason that becomes significant is because, yes, they may have their own private forecast they're using for their own marketing plans or their own recommendations, but it's that national, that USDA number that really has an impact on general market psychology for those people that are outside of the inner workings and inner circles of this forecasting world that some of us live in. So I want you to compare what is the average trade estimate for not only corn, but let's look over here at soybeans. What is the trade expecting? So this would be an average of about 20, I think it's 26 or 27 firms or individuals that contribute to this average. And I use the Reuters one. So on average, those private analysts are expecting that USDA will come up with a national average yield forecast of about 51.3 relative to 52, which is what we currently have. So they're looking at a slight decrease in yield and yield potential, but I also want to show you what is that range. And we have a pretty substantial range in forecasts. A lot of people are hovering around that one kind of 51, 52 number, but we do have a few people that are looking at that below 51. And again, when we do the math on this, that number starts to multiply out as we're looking at this 83 million acres. And so the concern is we're going to start to take some of that top end off of our total production. So we're looking at, original forecast from last month was about 4.3 billion bushels. We're going to take some of those bushels out of the potential mix, which again is going to start to tighten up our balance sheet and our bottom line. So we can look at also just a quick reference point on the corn number, because I know there's some people online now that are also concerned about the corn number. Right now, looks like on average, most of the traders are expecting about a 2 bushel per acre reduction in corn. Again, it'll start to tighten up that corn number a little bit. In my opinion, again, when we look at the yield ranges, it's a much wider range on the corn side. And that's one of the things, other comments I wanted to make just biologically. Soybeans is kind of an amazing crop, to be honest with you. It really has this ability to compensate for adverse weather conditions. So we tend to see a little bit more yield stability when you look at it on a percentage or variability terms than you would in corn. Corn tends to be a bit more yield sensitive to some of the weather conditions. And so I think that's one of the reasons we're seeing this larger, wider spread in the corn forecast than we are on the soybean side. All right, so I do want to make a couple comments on the demand piece. I know this is a little bit premature to be start talking about a lot about usage numbers at this stage of the game, but it is something that I want to plant some seeds so that as we go through the rest of the marketing year, we start to follow, what kind of the consumption expectations, and what are some of the things that might start adjusting our pricing mechanism, saying, well, first and right now, foremost, the yields and the total production. That's really what the market is focused on right now. How many bushels do we have to ration out? And if that number gets to be smaller, we're going to have to start increasing prices to ration a bit harder. But the second question I'm asking is, well, okay, so we start to raise prices, which I know a lot of farmers are very interested in. But the real question is, so how quickly will those buyers start to drop away from the markets? How price sensitive are the on the buyer side are they going to be? So at this stage of the game, again, a lot of the forecasting for the demand side, the consumption side of the ledger is a lot of it's based on history, mathematical forecasting, kind of the economic conditions that we see going on within the marketplace right now. So if we start looking at, again, crushing numbers, and I'll show you some longer term history, we are seeing a general growth over time in the crushing sector. The advantage of the crush sector obviously is once you build a plant and a facility, because of the heavy cost of the initial investment, there's a strong tendency to try and keep those bushels flowing through it. Even though the profitability of the plant might vary considerably from week to week or month to month, there is this incentive because we have that infrastructure to be able to keep pumping that through. So that demand base from the crushing sector tends to be a much more stable, a little bit easier to forecast and predict. The wild card, the one that's very difficult to forecast just because of all the global dynamics, is the exports number. USDA is starting to forecast, again, some additional slippage in our exports number. I'll talk about that in just a moment. So if USDA is correct, and again, these numbers will change on Friday, we're looking at a slight increase in our carryover stocks. Not a substantial one. It's not like we're, famously or rebuilding our inventories, but we are looking at a little bit larger inventory base coming into the new crop versus what we had last year in the old crop numbers. So just to put things in historical perspective, the blue line running through the middle is crushing. That's the crushing number going back into 2000. Again, beginning in about this early 20 teens, you can see this relatively steady chug or growth rate in the crushing sector. We're starting to see, again, some additional facilities come online. There's some plants that are also across the Midwest that have been expanding to increasing capacity, to increasing their throughput, as well as their refining capacity for the crude or for the soybean oil. Again, a lot of that driven obviously by renewable diesel and some of the energy sector. So USDA right now is forecasting that growth will continue. Again, because of the crush plants that are coming online, it's a little bit easier to forecast than the exports number. Now, again, our concern, obviously, from my perspective, is this multi-year downward trend that we're starting to see in the exports. The export volumes are a bit of concern. This drop that we saw here in 2018 and 19, those were obviously because of the trade war that we had with China. A lot of us on the online right now remember that. It puts a pit in my stomach every time I think about that. But we did have a rebound or recovery, but over the last several years, we've been again starting to lose some of our market share globally. Part of that is the price competitiveness from the crushing sector, but we have some very, very stiff competition coming on from Brazil. And I know Dr. Wilson will be talking about some of the things going on in Brazil and the impacts that has on grain flows in a few moments. So I just wanted to give a brief update on our export pace and who are the big buyers. So let me explain this very quickly. I just want to put this in perspective. I got a few more slides and we'll open it up for some questions. So these 4 columns on the left, so these are annual export sales. So these are the different marketing years. These are exports by country. So these are the U.S. soybean exports to these specific countries. These are all in million metric ton. Don't worry so much about the conversion to bushels. Let's just look at the absolute numbers. Obviously, China is our #1 customer. Even during the trade war years of 18 and 19, China was still our #1 customer by volume. Mexico has been one of those countries that has been slowly increasing over time. So even though it's a much smaller number, that is one of our growth markets. That's one of our next door neighbors that is also got an appetite for soybean oil and meal. They have a kind of a slowly growing crushing sector. And so they're looking to the United States as their major supplier. The EU, the European Union, typically falls either 3 or 4, somewhat behind Mexico, depending upon what other countries are doing. Obviously, back here in the trade war years, that became kind of our major alternative market. But again, with relative size of the Chinese market versus Europe, there just wasn't enough capacity there to be able to offset. And then Egypt being the top 4. Now, the 2 columns on the far right-hand side are year to date. So this would be, I want to focus first on the column on the far right-hand side. So these are the export sales for this marketing year, starting as September 1 last year, running through basically the end of July. So how much soy have we exported but to various countries so far this marketing year? Now, again, the end of August, we only have about a month left in this marketing year before we close out the numbers. And then this column just to the left right here is the same time period. So notice that we have a 2021-22, which is the year-end closeout. And then we have the amount that we've sold from September 1 through the end of July last year versus this year. So there's 2 different timing horizons. And I know the numbers on the bottom are different. I'll talk about that in just a minute. My point in bringing this up is when we look at today's export pace relative to history, relative to this time last year, we're well behind last year's pace. And again, a lot of that we learned and found out early on in the marketing year. There have been, and a lot of that was because China was coming in at a slower rate than we typically see. That has basically slowed to a trickle right now. Those numbers are not changing. We have seen some additional export sales into some of these other countries, into some of the Asian countries over the last several months, which is starting to pick our totals back up. But again, their volumes are really not large enough to compensate for some of the slower pace that we had coming out of the Chinese market. Now, just on a sidebar, because I know somebody's going to ask the questions, when you look at this at the end of July versus the final numbers, why are there some of those countries actually have a decrease? For example, China has a small decrease from July through the end of the year. Part of that is, yes, there have been a few cancellations that happen at the end of the year, but typically we do see some transfers. So this is what we're doing is counting what Department of Commerce is doing is counting the contracts for sale. So these are contracts that have been signed for delivery within this marketing year. Well, as we get closer to the end of the marketing year, some of those contracts are renegotiated and those deliveries are going from one marketing year into a different marketing year. So essentially they're getting rolled forward. So a particular buyer said, look, I originally wanted to take delivery at this time frame, but you know what, given what's going on right now, I'd like to roll that into a different delivery month. And so what happens is some of those bushels that were originally going to be delivered in this marketing year get rolled into the next marketing year. Thus, the totals will decrease slightly. So I just wanted to explain that because I know somebody's going to ask the question. A couple more slides, and we'll take a pause and I'll answer some questions. Want to make sure that we get everybody's kind of perspective on this, and I'm able to address what you consider to be important. So again, just to kind of tee things up a little bit to try and set up some of the comments that Dr. Wilson's going to follow up on. One of the challenges we're facing internationally is that we have very stiff competition from Brazil as well as from Argentina, but particularly from Brazil. And I'll show you another chart in just a minute. So this is total production. So these are total bushels produced. And as you can see, from the blue line is Brazil, the green line is the United States, Argentina is the black line. The little dots on the far right-hand side are the current USDA forecasts. They're the current estimates for this 2023-24 marketing year. Now, for Brazil and Argentina, that will be estimates for the crop that's going to be harvested this winter. So these are bushels that actually haven't even been planted yet. So they're forecasting planted acreage as well as a trend line yield, just to give us an idea and reference point, okay? So the point I'm trying to make in all of this, yes, there was a lot of discussion, and I know over the last winter I was spending a lot of time talking about Argentina, the production issues in Argentina, the smaller size of the Argentine crop. And that did have an impact on markets and market psychology, in particular globally. But when we look at what happened in the Brazilian market, that blue line on top, the increase in Brazil was more than enough to offset the decrease we had in production in Argentina. Now, that does have some implications for soybean trade, but also has some implications for international trade in soybean meal as well as soybean oil. So let me shift gears a little bit. Now, the previous slide was total production. This is soybean exports. So of all the bushels produced, how many actually hit the international market? Let me start with Argentina on the bottom, which is the black line. So Argentina doesn't export a lot of whole soy. Most of the soybeans that are produced in Argentina run through some kind of crushing facility, and then they're exported as either soybean oil or soybean meal globally. And part of the reason for that is their tax structure. They're trying to, there's an export tax on both oil meal as well as raw soy. And the incentive system is trying to process the soybeans domestically rather than just selling whole soybeans and competing directly with the Brazilians. Okay, so thus, as a result, there's very few bushels of whole soybeans that get exported from Argentina. So the reduction in production out of Argentina had a bigger impact on soy, oil, and meal prices globally than it did on soybean prices as a whole seed. So our majors, basically the two major suppliers of whole soybeans, of the whole seed, would be the United States and Brazil. And when you look at the Brazilian production as well as the Brazilian export numbers, they have surpassed the United States for about almost 10 years now. So the Brazilians have been the leading exporter of soybeans. We have been a really important player, but we're kind of the residual supplier, I guess, in my terminology. The other thing that I wanted to point out is that red line on top, which is the Chinese demand. So this is the amount of all soybeans that the Chinese have been buying off the global market. So I'm not breaking it down by how much did they buy from the US versus how much did they buy Brazil or other sources. I'm just saying, what is their total inflow or total demand base off the global market? And one of my concerns, I guess, longer term that we have to be thinking about is for about the last 20 years, we have seen this really nice, steady, methodical increase in the amount of soybeans that the Chinese have purchased off the global market. And it started to kind of plateau here a little bit. We got a drop off in the 2018 trade war, but a lot of this drop off in consumption was not just the trade war, but it was also the fact that the African swine fever occurred within the Chinese hog industry, and their demand for, in particular, soybean meal dropped pretty dramatically just because of the number of hogs. Now, over we had a couple of years of rebound where they started to refill some of their inventories. They still really don't have the African swine fever problem completely under control. It's under much better control than it was before because they made some changes in their production systems. But it's not necessarily fully kind of taken out of the marketplace yet. So they still have some variability, not only in the number of hogs, but the profitability of hog production in China. And so as a result, we're actually seeing kind of a leveling off of total demand from the Chinese market. So the question that we have going forward is this a plateau? Is this going to be kind of a leveling off of the demand base in China? Or is this just a pause in a larger growth trend? And I really don't have a very good answer to that. In my opinion, as we move over the next couple of years, the Chinese economy is starting to have some issues. The growth rates in the Chinese economy and the growth of their economy is starting to sputter a bit. It's not dramatically. I mean, it's not something that I'm concerned about the Chinese market suddenly falling apart or the financial conditions getting into major concerns or major problems. But their economic growth, the economic engine that they have been relying on over the last 20, 25 years is starting to slow. And so I think we have to be thinking about that and concerned about that as we see this continued growth rate in production coming out of Brazil, the preference for the Chinese to buy into the Brazilian soybean market, and what that means for long-term for U.S. soybean exports. So some of the concerns, I do want to plant some seeds longer term about what does this mean for our growth in our U.S. soybean industry. One or two final things, and I always bring this chart up. The blue bars in the bottom is that stocks to use ratio. So what we're looking at is we're taking ending stocks, the amount of inventory we have just before harvest, divided by our total consumption. So what percentage of our total needs will be in reserve in case there's a problem next year? So rephrasing that, how tightly do we have to ration our usage, ration our consumption to make sure that we have some inventory left, but not too much inventory left? And typically what happens is when those blue bars are small, when inventories are very tight, we have to ration our consumption very hard, which means we have to have big increases in prices to be able to get people to change their habits. And as a result, when prices get high and inventories are very tight, we also tend to have very high levels of price volatility. So prices become very, very sensitive to new pieces of information. If we have very large carryover stocks, if those blue bars are very big, we have lots of inventory, the bins are full, we don't have to ration nearly as hard. And new pieces of information that come into the market, they're still important. They still change market perspective and psychology, but they don't have the dramatic impact. So typically when we have large inventories, we tend to have lower average prices and a lot more stability in the marketplace. So here's my point. When we start looking at the carryover stocks for old crop, and then now the forecast for new crop, we are slowly starting to rebuild our inventories into more of a typical zone, I guess a typical time frame, rephrase a typical inventory levels that we've seen in the early and mid 2000s, but we're not excessive. Okay, so the whole challenge we have is as this number, if we start to get some yield drag, if those top end yields, especially in those heavy producing regions, start to drop off a little bit, we start to see prices start to increase and that rationing start to be much more intensive, we tend to see, again, this price volatility. And I guess that's the moral of kind of my last slide, is we see a pretty strong correlation between our inventory levels when inventories are really big here in the mid 20 teens versus the early 20 teens. We can see that volatility showing up here. When we get in the mid 20 teens, when we had big inventories versus the early 20 teens, and even right now. So this blue box right here is where we were at about 9 o'clock last night. This is nearby futures. So this would be old crop futures, not new crop futures. But you can see that price volatility. And in my opinion, we're still in this range, even though we're coming off of the highs that we saw earlier on this season, we're still at some pretty respectable price levels. And then this is my last slide. Again, this is a screenshot of the markets from last night. I'm going to take a short pause here to answer some questions, and we'll dive into more of this technical technical analysis to start looking at shorter term price movements. But we've seen this retracement now as we start to get some more rainfall, as the pressure is coming off of the yield forecasts, as we start taking some of that risk premium back out of the marketplace. Okay, so with that, I'm going to pause. I'm going to stop sharing. We're going to open it up for a couple of questions before I dive into my next section. So Jenna, do we have anything in the queue?
I do not see anything in the chat, but I want to look and see if anyone's raising their hand or coming off mute, but I don't see anything. Frayne, that was a really good, comprehensive review of where we're at with the markets right now. And you must not have left anything to question.
Either that or it confused everybody. They don't know what to ask.
So if anything comes up, I mean, we're all together all morning. So if anything comes up, put it in the chat. We'll keep an eye on it. We do have you, Frayne, scheduled for your technical analysis. So if you're good to go, I think we'll have you just jump right back in.
All right.
I'll keep monitoring that chat.
All right, very good. So again, if you think of something, again, I'll be on throughout the entire session. So if there are things coming up later that you want to talk about or visit, I'd be happy to do that.
Sounds good. Mark says you can talk as much meteorology as you wish.
Well, I'm not trained as a meteorologist, so I want to put that out there. All right, so I'm going to share my screen again. We'll go up here. And I'll dive up. Oops, I'm going to have to escape out of that. I'm going to pull up some of this. So this is, I know this first slide is going to be a little bit tricky to see, but this is through DTN ProfitX. This is one of the things, the software programs that we have in the commodity trading lab here at NDSU. I use this extensively to try and follow what's going on in the marketplace and to try and do some analysis. So I'm going to pull up some charts. I'm going to do this live. I'm going to do this real time instead of having a static PowerPoint slide, so we can have some more discussion. So the flashing that you see right now is active trading. The market's open again at 8:30 this morning. Soybeans, the soybean market is right here kind of in the middle of the screen. We have the different contract months that are available. On the left-hand side, we have the corn futures market. We have hard red spring wheat down here in the far left-hand corner. So I'm going to be focusing on, in particular, November soybeans. So I do want to make sure that we have live information. There we go. So the advantage of doing this live is that as the markets change and adjust, we can start to see that showing up on the charts. And so all of the numbers that I'm showing you, all of the analysis and techniques that I'm going to be talking a little bit about will be updated every time that you see those flashing blue or gray areas on your screen. So this is going to be kind of a live interactive view. So one of the advantages of looking at a technical standpoint, the supply-demand conditions obviously sets the stage. The technical part of analysis or looking at markets and market behavior provides typical a little bit shorter term planning perspective. It gives us a little bit more immediately what's going on today. What are the immediate trends? What is the momentum in the marketplace? And one of the reasons I'm only going to show you a handful of techniques. These are the ones that I see, I guess, most commonly used and discussed within the grain marketing, the agricultural commodity marketing world. There's a lot of different techniques and different structures in place. I'm not saying that these are the best or that these are the only ones you should use, but these are the ones that I look to, and these are the ones that I see most commonly discussed and talked about in the trade, kind of from different market analysts and different perspectives. So I do want to at least demonstrate how you might be able to use this information. There are free websites and sources that you can go to be able to pull up these charts and do some of your own analysis if you wish. We can talk about that later on if you want. I did want to use this DTN ProfitX because this is something I'm familiar with, but it's also something that allows a lot of flexibility in being able to demonstrate and talk about what's going on. So I'm going to focus on new crop soybeans. We're going to look at the November futures contract, which is the one that most of the new crop is being priced off of. And I do want to pull up first this chart here. So I'm going to go through a couple different ones and show what's going on and how to interpret this. So this is called the Bollinger Bands. Basically, it's looking at, we're looking back historically and saying, what are the price trends? What are some of the price movements that we've seen historically relative to what we might happen, what we see happening in the future? Okay, so we're using the past as a kind of as a mechanism to try and anticipate what might happen moving forward. So what this is, the blue line, let me explain very quickly. The blue line is a 20 period moving average. So what we're doing is, because this is a daily chart, every one of these black bars here represents one trading day. We're looking at the last 20 trading days. So this, and again, if you think about 5 days a week, this would be 1 month's worth of trading. So the blue line represents the average price that we've seen over the last month. And so what's going to happen as we get new information, that average will be recalculated, as well as those red lines will be recalculated. But we're really looking at the 20-day moving average. So tomorrow what's going to happen is we'll drop a day, we'll add a day, we're going to recalculate everything, and we're going to look at what's happening in this moving average. So moving averages are sometimes called support and resistance levels. We're looking at saying, well, where are we today relative to the last monthly average? So if we look at today's prices, the black box, is the current trading. So it's at $12.91 right now in the futures for November soybeans. This 13.67 would be the average futures price, the average closing price for the November futures. So we're using that as kind of our baseline, saying, well, this is our midpoint, this is our average. And we have this range. What is the typical trading range that we have seen, again, using the last 20 days or the last month as that reference point? So that also changes. So what we're doing is we're looking at it saying, not only calculating the average, but we're also calculating the standard deviation, which is really a measure of variability. So think about this as this is an upper range and a lower range for prices that we've seen over the last month. Now, as you can see today, right now, we're trading at the bottom end of that range. So what this is signaling to us, if you're going to use this Bollinger Bands as a kind of a methodology to think about what are the market trends, what is the momentum in the marketplace, what are we seeing as price movements as we move forward in time, we're starting to see this retracement. So two things to think about and look at is what's happening to our average. So our average is starting to slowly tip downwards or trend downwards, which is again signaling that we're probably taking some of those profits out of the marketplace. We're taking some of the risk premium out of the marketplace. But we can also look at this range. Notice the shadowed area, this range right here. So when we have prices that are relatively stable, let's go back to what happened last year in February and March time period. We had relatively stable prices. You'll notice that trading range, what that normal range was, started to narrow up. We've got less volatility in the marketplace. Okay. Now, when we get into the growing season where we're getting weather conditions and uncertainty about what's happening, we're seeing a lot more price volatility. That typical range of trading starts to get very wide. So anytime that we see today's prices starting to touch this red line, either on the bottom or the red line on the top, what it's saying is we're getting a pretty aggressive price correction, an aggressive price movement. And obviously right now we're looking at that downward price pressure. We can think about those black bars touching the red line on the very bottom as a strong signal to us that we have some significant downward movement, some significant downward pressure in the marketplace right now. And that's being confirmed by our analysis. So even if we looked at the last 20 days, today's numbers we're seeing is relatively low compared to that reference point. All right, so I'm going to add one more study here. I'm going to add another way of looking at this. I'm going to look at the Relative Strength Index, RSI. So I'm going to keep this up and we're going to add one more. So RSI, Relative Strength Index, what we're looking at it as a ratio of the number of up days, how much have prices increased relative to how much have prices decreased over a specific time period. So in this case, we're using 14 trading days instead of 20. And we're looking at this moving average, this ratio. So think about it, a number of 50 would mean that the price increases we've seen over the last 14 days are equal to the price decreases. Okay, so that would be kind of a neutral type of market. We're probably looking at a sideways kind of market. When we start falling below 50, that ratio, like we are right now at 42, it's signaling that, as you can see, that we've started a downward trend. And you notice that at this peak here, and you start matching up, this is a mathematical relationship, that this relationship, this ratio of up days versus down days is starting to tip over, and we're starting to get some downward movement. Okay. And so this is, again, another measure of momentum, not only the direction of movement, but how rapidly is that changing. And because this RSI, this Relative Strength Index, is still downward trending and not starting to curve or looks like it's forming a bottom, the signal that we're getting off of this is that, yes, we're in a downward trend. We're coming off of some larger numbers. We're coming off of some strength, but we're seeing more of those downward days. So now we're starting to get into this downward momentum. And the question is, how long will this downward momentum last? Where will this start to stabilize? Where are we going to start putting in some bottoms? And then what's going to happen is we're going to see some recovery, or is this going to continue to be a longer term price downtrend that we're looking at? Now, the way that you interpret this, I know it might be a little bit difficult on your screens to see, but if you notice, there's a red line up here at 80, and there's another red line down here at 20. So as we look back historically, it gets very difficult, even mathematically, it gets very difficult for this ratio to get above 70 or even get close to 80. So anytime we get in that range between 70 and 80, what that is signaling is that we have had a very strong either upward movement or a downward movement if we're in that 30 to 20 range, and that the momentum, it's going to be really hard for the marketplace to continue that level of either price increase or price decrease. And so as we start to get above 70 or below 30, these are usually signals that bottoms will likely form. And it's very rare when you look back historically that we even get close to this 20 line or close to the 80 line. So right there, we're coming off of a downward trend. We've had I would call it a gentle upward movement. We're looking at as though we're taking a downward movement right now. The question is, where will that start to stabilize? Where will it start to turn? Okay, so let me add one more indicator here. And I'm going to use this MACD, which is moving average, convergence, and divergence. Again, another way of looking at these price movements and what's going on. So now I have three different measures. They're looking at the marketplace from slightly different perspectives, but each one of these, we're trying to measure the kind of the momentum, not only the direction that we're looking at, but also the momentum. Are we in a downward moving market? And if so, is that downward moving market a strong downward movement, or is this something that might be starting to stabilize? We're looking at some bottoms forming. So let me explain this last one very quickly. So we have two lines on top here. We have the red line and the purple line. Those are, again, moving averages. They're a short-term moving average and a long-term moving average, or a longer-term moving average. The difference here is that it's not a simple average. We're just taking 20 days or 30 days and adding them up, dividing by 30. We're actually weighting it. So we're saying that the information that we have in today's market has more weight, more importance than what happened 20 or 30 days ago. So the memory, it's like the memory has the market has a memory. We are including what happened 20 days ago in our kind of our analysis, but we're not putting a lot of weight or emphasis on what happened a long time ago. We're putting much more emphasis on what's happening currently. Oops. Now, why did that disappear? Right here, we'll pull that back up. So we're looking at this short-term average versus a longer-term average. And I really want to focus on these bars, these purple bars. So those bars represent that distance, the distance between those two lines, to make it a little bit easier to see what's going on. And the interpretation of that distance, those bars, is what is the general price direction, but also, again, what is the momentum? So essentially what it's saying is that, for example, here on an uptrend, if the bars are above the midpoint, above the zero mark, it's saying that we have an upward trend forming and the prices are increasing. So the height of the bar represents how rapidly is it increasing. So we start out with slower momentum. Prices are starting to build. They're increasing more and more rapidly. They reach this peak. They continue to go up, but not at the same rate. They're starting to increase. The rate of increase, the rate of that price increase is starting to slow. So what's happening now in this downward trend? So we're below the zero mark. So we're in a downward trending market. It's looking like this downward trend is starting to pick up some additional momentum, pick up some additional strength. And based on these bars, then it also looks as though that downward pressure, that downward momentum that we're seeing right now has not yet abated. It's not yet slowed. So what we're looking for is these bars to even though they might be negative, but to get shorter or smaller, meaning that those downward trend is starting to lose momentum. But that really hasn't shown up yet. So based on these indicators, not only what's happening just logically within what's going on in this downward trend we're seeing over the last week or so, that we've had some pretty heavy downward days, but we're also looking at these trends, those momentum, that downward pressure, that downward momentum has not abated yet. It's not slowed up yet. We still have this negative news. We have this negative pressure into the marketplace. Again, what some people are saying, we're starting to take some of that risk premium out of the market. Okay, so these are things that we're looking at as a dynamic assessment of the marketplace. All right. Now, I want to, again, take a short pause here because I will likely have some additional time for questions at the end of this. I just want to look to make sure that I'm on time here. I'm not getting too far ahead of myself. But I do want to take a short pause. Is there any questions right now so far about the momentum? So we're looking at three major indicators. I'm going to talk about what might be stopping points in just a minute. Three major indicators of not only price direction, but price momentum. They're all showing us essentially the same indicators. So if I've got three different gauges on my dashboard, all telling me kind of the same thing, I feel pretty confident that this downward movement will likely continue, at least short term. Now, the one more thing I'll say before I pause is that these indicators, again, are relatively short term. So one of the kind of guidelines or the general rules of thumb that are used within this technical analysis is that depending upon your planning horizon looking forward, so let's say your planning horizon is the next 2 weeks, that'd be about 14 days or basically 10 trading days. So if we're looking at a 10 trading day period, if you're looking forward, that's your planning horizon for making a decision. You should probably look about 10 days backwards. So again, a general guideline. So what this is saying is over the next month, what are the general trends that we might be seeing? What are some of the things that we might be looking? If your planning horizon is about 20 days forward or 20 trading days forward, about 1 month, these indicators should be a pretty good idea. We should look back about 20 days as that reference point. Okay, so before I jump into kind of my next big question about, well, if we have this downward momentum, where will that momentum start running out? I'll take a pause right here to say, are there any questions other than Mark's comment about doing weather?
I don't see any in the chat, Frayne. Anyone with any questions, feel free. Like I said, you can raise your hand. If I see someone come off mute, I'll know that's why. But so far, Frayne, I'm not
All
seeing.
right, very good. I will continue. Okay, so what I'm going to do right now is I'm going to minimize this. I'm going to show you one more kind of charting technique that's often talked about. So this is the moving averages. Remember I talked about that 20-day moving average? So the colors change here a little bit, and I did that on purpose just to show some different reference points. So the red line right here is a 20-day moving average. So that would be about 1 month average. So this would be the average closing price for about the last month. Okay, so the blue line is a 40-day moving average. So now we're looking at a 2-month average. So we're looking back further in time, saying, well, what reference point do we use for kind of what would be typical? And then the green line is a 90-day moving average. Now, there are some analysts and traders that will use a 100-day moving average, which is fine. I chose 90 because that's also a common number. So the 90-day moving average really represents a 3-month average. And why is this important? So we're looking at, this is called moving average crosses. We start looking at essentially 4 different time periods. We have the black bars, which is what's happening today. We've got the red line, which is a 1-month average, the blue line, which is a 2-month average, and then the green line, which would be, excuse me, I do my math, would be a 3-month average, correct? So these numbers can also be used as support and resistance levels. Thinking about, well, you know, yes, we can be kind of above average or below average, but when we start to see a short-term line, a short-term price movement crossing a longer-term price movement, basically using that as a support or resistance level, that's an indication that something has changed, that we're now starting to see the momentum in the market shifting and that we're looking at some different dynamics. So we saw, if let's looking back over time, you saw the downward price movement that we had pretty much most of the spring work into this early June time period when we got that some more information on not only planted acreage, but also on yield and yield potential. So we started seeing this red line, the black line starting to cross red line, which was an indicator that, you know what, this downward pressure may have started shifted even over a longer time period. And then as we saw the red line starting to cross the blue line, that was additional confirmation that this is not necessarily just a short-term event, not something that happened just short-term, but also might be a longer-term shift in market and market potential. And then as we looked at the blue line crossing the green line, again, there's additional reinforcement that, yes, we have seen a fundamental shift in the way the market is responding. The dynamics have changed, and we're looking at it, again, a longer time period. So when we start thinking about what are those key pricing points, if we start to see now a downward price movement, a downward trend line, and looking at it in a dynamic framework, you know, kind of this flexible framework, what are those key support and resistance levels? So when we say key support and resistance levels, think about them as like psychological barriers. So if we start to see prices fall, at what point will buyers look at that and say, oh, this is a buying opportunity. I'm going to start to step in and say, well, based on everything that I know today,
this looks like a really good buying opportunity. I'm going to try and lock in some more purchases, try and hedge some more of my price risk, and the buying incentives start to overwhelm the selling. And so obviously, as prices fall, the number of buyers in the marketplace, the volumes that they're starting to purchase start to increase. And obviously then also on the selling side, as prices fall, the number of sellers as well as the volume of selling starts to drop off. Thus, the reason we're trying to find this balancing point between what the suppliers, what the suppliers or sellers are looking for from a pricing standpoint and what the buyers are looking at. And we're trying to match up this buyer and seller incentives. So the red line, the blue line, the green line can be looked at as one of those key pricing levels, saying, well, okay, I want to have an average price. I'm looking at it as a buyer, either an international buyer or looking at it as a commercial buyer domestically, and saying, look, I know that I'm never going to hit the high of the market. I'm never going to hit the low of the market, but I want to be kind of in this average. I want to have below average purchases, or my purchase price being below average, or as a farmer, I want to have my sales prices being above some kind of average level. So the question is, what do we use as that reference point for average? So we could look at a 1 month average, we could look at 2 month or a 3 month average. Or excuse me, it'd be a 4 month average. Excuse me, I'm doing my math wrong. The 4 month average is the green. My point in saying this is, okay, we're now at those points, we're looking at today's pricing levels, where the green line being a 4 month average, we're looking at today's prices right at that 4 month average. So the question I'm beginning to ask is, well, have prices slipped far enough? Have they come down far enough that buyers, whether it be domestic buyers, whether it be international buyers, are looking at these pricing levels saying, hey, here's a pricing opportunity. We're finally getting to a point now where I can average my purchases lower. The prices have fallen enough. I need to make some additional purchases. Should we start booking some additional buying habits or buying volumes? On the flip side, from a seller's perspective, our price is falling enough to say, nope, this is at a low enough price. I'm not going to be able to I'm not going to sell at these price levels. Again, this is a psychology decision. It's as much as it is about the math of what's happening on the supply-demand basis. So we're seeing, as I said earlier, a 20-day moving average slowly tipping down, but our 2 month average and our 4 month average, 2 month average is still moving upwards. So we're not necessarily starting to trend downward in a long-term sense. We're also starting to stabilize in our 4 month moving average. Okay, so we've got some more mixed signals, but think about these lines as, again, support and resistance levels. All right, so I'm going to minimize this. I'm going to pull up one more chart. And this is the one for those that have heard me talk or listened to me. Even though I do look at those other momentum kinds of indicators, because they do provide information, it does give us a perspective on what's happening in the marketplace. I'm a firm believer in the KISS rule, keep it simple, stupid. And I fall into that category. So when I look at that, I like to use something that is very quick and easy to be able to get a reference point. And so over time, I've become very comfortable with using these straight lines as support and resistance levels, as again, psychological barriers or indicators of where prices might reach a point of inflection, where we're looking at prices turning. Either an upward price trend is starting to maximize or top out and start turning downwards, or now as we go into a downward moving market, at what price levels are we going to see those support, where again, the number of buyers will start to outweigh the number of sellers. And so the technique that we're using, we're looking back historically, and we're looking for these price peaks. Now, there's part art, part science to this. So I don't want to get into a large discussion. You could obviously pick some different pricing points than I have picked here, but these are the ones that I've chosen to use. So let's start at the top and work our way down. If we were to look back, a bit longer term, so I'm going to scroll this over here. If we were to look back into May of last year, this is May of 2022, this was the contract high. So 1448 was the highest price that we've ever seen for November 23 soybean futures. So we look at that price spike where prices went up that level and stopped, and that right now is the contract high. So I'm going to scroll back to where we are today. Okay, and you'll see this black box, which is where it's trading right now, slowly move up and down as I'm talking. We had a recent high of about 1435, and that happened back here on July 20, what was that? July 25th, 24th at 1435. So again, that's when we started to see kind of this maximum concern and issue about the size of the crop and are these drought conditions going to be a major concern. And it was at 1435 where all of a sudden the selling interest, the amount of selling volume, overwhelmed the amount of buyers. And so psychologically, that became kind of this tipping point, this turning point of where the buyers and the sellers, where sellers outweighed the buyers. So we start to see prices fall. So the next question is, so at what point will we start to see these prices stop? At what point will the number of buyers start to outweigh the number of sellers? And what we're looking for is these previous spikes. Now, technically I could have, and I for a while was using this spike point, but because this more recent one was higher, I'm looking at today's numbers working backwards. This was a spike that we saw more recently. So again, the information in the marketplace today outweighs the information that was contained back here in December. So even though we use that as kind of a pricing point, this is more relevant into today's market conditions. So we've already broken through this price level on the way down. We've broken through this price spike that we saw in July. We've now broken through these lower market levels that we saw, again, where prices have fallen and the selling started to drop off and the buying started to kick in. So as of the middle of July, there were some buyers that say, that 1325 looks like a nice pricing point. I'm going to put some orders in to say, well, I'll purchase some additional bushels at that 1325 level, but we've broken through those and we're touching now this level here at about 1287 or 1288. We're at 1291 right now. Notice that this was a pricing point we saw back here in May. So we saw retracement, prices spiked, but then they started an additional retracement. Now the question, this is kind of a debate on how do you read these charts. Do you use the low of the day, which again, depending upon what goes on in the rest of the day, may have occurred right now, or do we use the current price or the market close? So the point that I'm getting at is, we're starting to come down into this 1480, upper 1480s, 1280s, 1290s. It looks as though that 1290 point might be a stopping point. We'll have to see what happens later on today as the markets close, but more importantly, what happens tomorrow. If we start to see this 1290 kind of being that holding pattern where all of a sudden the buying interest starts to overwhelm the selling interests, okay, it looks like 1290 might be that holding point where we at least short-term put in a temporary short-term bottom. Now, if it breaks through, if it continues to make its downward trend, we've got this 1256 number, which we occurred back here in late June as another pricing point that we might to see that downward momentum stop. And unfortunately, if we break, in my opinion, if we break through this, we're going to have some much lower levels. We might get below $12 here if we start breaking through this 1250 mark. So over the next several weeks, again, a lot of this is short-term, is going to be driven by weather and weather forecasts, as well as the information that we get on Friday. I know there's going to be some people taking positions, getting ready for that Friday report from USDA. My suspicion is, at least until Friday, through the end of this week, my best guess right now is we'll probably be in that 1290 range, slightly above or slightly below. People kind of get their positions in place, waiting for that information on Friday. And again, we'll wait to see what happens on Friday, and that will set up for the trading conditions going into next week. So with that, I know I'm a few minutes early, but I did want to make sure that I finished in time to answer any kind of questions. So I'm going to take another pause. I do have two or three more slides that I do want to talk about, but I want to make sure that we answer questions first. So let me stop sharing here and get my other slide deck up. Are there any questions before I move into my last couple slides?
I'm watching here, Frayne. I'm not
all right.
seeing any, but people may be formulating those questions. So maybe do your next few slides. Right. I'll keep an eye on it.
All right, very good. I'm going to pull up one more slide deck here. And then we'll do our best to share screen here. There we go. So as I said earlier, I do have all of the stuff that I just talked about. I did screen captures of the technical analysis as well as some of the definitions. Again, I shared this information with Jenna last night. So if you do want to use that as a reference and use that for additional information in the future, go ahead. The last thing that I want to talk about, and again, I want to tee up and set things up for Dr. Wilson. I do want to talk about storage and kind of the cost of carry. So the marketplace right now, we're looking at two different things. We're looking at what is happening with general price movements. Is the markets for all tradings, let me break out of this for just a second. If we look at what's going on with these different trading months or these different contract months, the November, January, March, May, July, they all tend to kind of go up and down together, but not always at the same rate. So even though they have the same general price movements, these different contract months on the futures level are also trying to signal what is there an incentive, if anything, for storage. So how do we want to try and ration our production out through over time? So the futures market is a really big signal that looks not only domestically, but also to some degree internationally to say, how hard do we have to ration this consumption over time? Is there enough of a premium in the marketplace, this price differential between November and let's say January, to incentivize storage? So we sell some today, we're going to provide an incentive to store that crop and save it and deliver it in the future. So you can contract today and lock in today's price, but deliver in the futures or deliver at a future time period. And so there's two components to it that we have to watch. And I know Dr. Wilson will talk about this because he previewed his slides with me. It's not only is there the carry in the futures market, this price differential between the November and the January market, but also what's happening in basis. So think about the futures market nationally signaling to all farmers in the US, what are the incentives to store crops? Okay. And how much of that cost of storing will the futures market pay? So that would be, all farmers in the US. When you look at the basis levels, that's much more of a local market, a much more local dynamics, and saying, well, from a local perspective, is there an additional incentive or possibly disincentive to either store crops for later delivery or not? And I know Dr. Wilson will talk about that in more detail about what is your local market signaling from the basis level. But it's those two numbers, both the futures market, is there a carry in the futures market, but then also is there a carry in the basis that sends a signal to you as producers to say, should I store my crop? Should I try and price it today? I can lock in a price today and then deliver sometime in the future. Is there enough incentive to do that or not? And if there isn't enough incentive and I decide I am still going to continue to store my crop, what really that means is you're speculating. You're gambling on the fact that the future will change and the prices will increase, and that cost of storage will be paid. Your return for storage will be paid not necessarily in the differential from month to month to month in the carry, but really from a speculative perspective. And so let me go back to my question here. Oops, let me go back. I have to do this right here. There we go. So there are really different components to the cost of on-farm storage. And I know a lot of you do a lot of on-farm storage, not necessarily commercial storage. There are different components. I want to make sure that we cover from a full costing standpoint. We have the cost of the facilities, the bins, the elevation, whether that be an elevator, a grain auger or a leg system, your dryer system, depending on how you're set up on your farm or storage facilities. You have the labor that's required to load and unload. And a lot of times the facility costs and those labor costs are kind of written off as overhead to the farm. We want to make sure that we have harvest efficiency, that the combines aren't sitting in line someplace, even though the commercial elevators right now have some pretty quick unload times. But sometimes it's more convenient and much more efficient to be able to deliver from the field
into the your on-farm facilities rather than going into commercial storage. We might have a few extra miles that are driven because you're driving not directly to the elevator, where you have to say take a side trip and go into your yard to be able to store that, and you obviously have to haul it out. So it might be some additional costs for mileage. We have the cost for aeration and monitoring to keep the crop in condition, because after harvest we're going to have to make sure that we have that. We have this risk of spoilage or quality degradation. And we have, finally, in my opinion, one of the things that I want to really spend some time talking about is the costs, is the interest cost of carrying that inventory. So if we look at it from a full costing standpoint, these are all the costs that we should include. It's that last cost of inventory that, in my opinion, a lot of farmers have not fully compensated for yet. So I'm going to go through a really simple example. Let's look at the interest costs of carry for today's prices. If we were to contract today, you know, and I looked at several different elevators throughout the region, we're at about $12.25 is kind of a typical price for harvest delivery. Okay, so if we take that $12.25 and say, look, we could get $12.25 delivering off the combine, but I'm going to put it in storage, and I'm going to incur those costs of storage either because there is an incentive to store in the marketplace, the market is signaling that, or because I'm willing to gamble or speculate that prices are going to go higher. So we have to think about this opportunity cost of money. If you were to sell off the combine, you could take that money and either pay down some additional debt or reinvest it in your farming operation or reinvest it in some outside investment opportunities. You could earn some interest on that. So last year at this time, a lot of operating notes and interest costs were on that 4, maybe 5% interest. I just picked 4 as a nice round number. So if you take 4% interest, which is an annual rate, times 12.25, divided by 12, you get about interest cost, or the cost of carry, the cost of owning that crop and keeping it in the bin, at about 4 cents per bushel per month. You know, and so a lot of farmers are saying, you know, for 4 cents a bushel a month, even though I might have some additional costs, I'm willing to take that gamble. I'm willing to use that. The cost of carry, the marketplace is incentivizing me to store grain and deliver it sometime in the future. So 4 cents a bushel a month, pretty reasonable, not necessarily a big number that I have to worry about. Well, now let's fast forward into today's interest rate realm. And a lot of operating notes, and I've talked to several different ag lenders as we move into not only 23, but also now into 2024, operating notes are going to be typically very common in that 8% interest area. So our interest costs have nearly doubled. And on soybeans in particular, because of the high prices that we're seeing, that cost of carry has increased substantially. And I'm really concerned that a lot of farmers are making decisions about storing and on-farm storage and how long should we store based upon that 4 cents a bushel a month rather than the new number, which is really closer to 8 cents per bushel per month. So if you take, again, 8% interest times 12.25, divide by 12, which puts it on a monthly basis, we're looking at a little bit over 8 cents a bushel per month just in interest costs. That's interest costs only. So again, for the cost of storage, to earn money by storing your crop, you're going to have to earn at least 8 cents per bushel per month just to pay the interest. Now, for several years ago, I prepared a grain storage cost decision tool. It's a spreadsheet. It's actually information. The basic spreadsheet was put together by Iowa State University. And I took that. I got permission from them. I took that information. I modified it, and added some additional things to kind of customize it for trying to calculate on-farm storage costs here in North Dakota, or at least the Northern Plains area, excuse me. So you can search that. The easiest way to find it is just to Google or use your favorite search engine. Go NDSU extension storage costs, and it should pop right up. It's a spreadsheet you can download. I have a template. I have some examples that I put together earlier this spring to go through some examples. You can enter your own numbers and be able to figure out and do the cost comparison between what does it cost for you on farm versus what it would cost for commercial storage, and look at that cost versus what the revenue side, the earning side that you can get from the marketplace. And I know this is, again, what Dr. Wilson's going to be talking about in a few minutes is, what is the market signaling? How much will the market pay you to store your crop? And is that cost, is that revenue high enough to justify the costs? So based on my kind of quick back of the envelope calculating, if you were to consider all of those costs, not just the cost of interest, but the full cost of storage, where you paid all of the bills for owning your facilities, for the labor that you got involved in loading and unloading and managing, as well as the risk of spoilage, the cost of storage for soybeans in today's world, based on my rough estimates, are somewhere between 11 and 12 cents per bushel per month. That's on-farm storage, guys. That's not commercial storage. And I looked around to see if some of the elevators had adjusted or published their commercial storage rates right now. I was not able to find anything, but I'm guessing, I'm very suspicious that as harvest out starts to begin and we start to update websites, that I think the cost of commercial storage is also going to fall in this range. So 11 to 12 cents per bushel per month, I think, will become a common number, mainly because of that increased interest costs. For corn, we're still at about 5 to 6 cents per bushel per month for corn, mainly because the interest costs are a little bit lower and prices are a bit lower per bushel. For wheat, based on my math, it's somewhere between 7 and 8 cents per bushel per month. So the last big takeaway that I want to send before I hand things over and we transition into the next phase here is I really want you guys to be thinking about that the cost of storage on farm has gone up, and not to use the back of the envelope calculations, your gut feel that you've had over the last several years, because this interest costs have increased substantially. And so we're going to have to adjust our marketing plans. We'll have to be more, I guess, shrewd, in my opinion, and play this storage game a little bit differently than we have in the past. And so with that, I'm nearly at time. To actually, for me to finish on time is very unusual. For most anybody that has heard me speak before or seen me on a webinar like this, that is a rare occurrence. So I'm doing my best to improve my bad habits and finish up on time. So Jenna, again, I am a few minutes early here. I know we've got a break scheduled to give people a pause. I will be on for the rest of the program. So if there are things that come up later, I'd be happy to answer that. But do you see any questions that have come in while I was talking?
I do not. I'm very impressed at your timely ability.
My time management's getting better.
No, that's not why. You're just very directly on time. Make my job easy. So we will take a break. Fortunately, we do have Frayne all morning. So as he said, if you're just kind of soaking all this in and thinking about what you need to ask and what this means for you, please take some time to put that in the chat. We'll review it when it's appropriate. But for now, let's take a break. We will come back to Dr. Bill Wilson at 9:40. It's 9:34 right now. So we'll take a 6-minute break and we'll come back at that point. So see you all then. Hey, Bill, if you're on, we can
Yep.
we can get your slides set ready to go here in a couple minutes.
Okay, I'm gonna share them.
Yep.
Then you coach me through to be sure they're right.
Yes, can do that.
'Cause you're so good at that, and am not that good.
No, I'm not that good either, but we'll figure it out.
Okay.
Okay, so if you go to from beginning in the top left. There you
Okay.
go. And then
How's
go
that?
to display settings in the middle up there. And then hit that swap presenter view.
Right.
And it looks perfect.
Thank you.
We got 1 minute.
So how much time are you working now? When do you normally do your work?
Well, so I'm home with kids. So I usually am working like 6 a.m. to 7:30 and then like 8:30 to 10:30.
No, Greg Teven from Grand Farm.
Yes, I've seen his name. I don't know him.
Yes, he's a good friend of mine, and he's in a situation like you. I was just with him yesterday. He's absolutely going crazy. He's got 3 kids and can't find, and I just rolled my eyes. I thought of you.
Yeah. Yeah, I'm very grateful to be home with them and get the time. But yeah, it's a little crazy.
Can you see my pointer on the screen?
Yep, I can. So you can use it as a pointer.
Right.
And it is 9:40, so we will.
Okay, so should I go ahead and start?
Yes, so I'll do a quick introduction of
Okay.
you, though I think most people on the webinar here know who you are. This is Dr. Bill Wilson. As I said, he's a distinguished professor with the Department of Agribusiness and Applied Economics at NDSU. He is an expert on many things, but he speaks to us often about basis, and that's what he is going to speak about this morning. So with that, Dr. Wilson, I'll hand it over to you and I'll have you take it away.
Thank you. So this is a great topic for me. I spend a lot of time with this in my university class as well as my research. And so thanks you, and the Soybean Council supports a lot of my work and activities. So appreciate them and Jenna's council in particular. I'm going to talk about some big issues, the current market, the concept of the basis, shipping costs, and then at the end talking about some hedging issues, and then give you my outlook on the basis. I have to start with sort of the conventional way we think about interpreting markets and market signals. And these are 2 slides that represent the relationship between futures prices on the vertical axis and the stock use ratio on the horizontal axis. Frayne spoke to that. He pointed that we're probably about 5.8 this current year. At the top right of the slide, it shows the different values that we've experienced. We're at about 5.8 currently. If you compare that to the slides on the left-hand side, that would suggest we're probably evolving towards a price of $12.25. We would call that in economics the equilibrium price in an efficient market. Now, you may kind of roll your eyes at that because when I wrote this presentation, it was 1302. As of 5 minutes ago, it was 1243. So it seems as though we're pretty effectively moving towards 12.25 on the November futures price. Some of the key factors that are driving this thing is Brazil. Frayne spoke to that. In my class, I teach it during this fall semester as we go through planting season. In 2022, we produced 142. In 23, early estimates were 149 million metric tons. Saffras increased it to 155. More recently is 167, which is the largest crop on record by far. And next year, the current estimates are 163. So this is the key driver to both the futures market and, as I'll show you later, the basis market. These are Jenna's slides, which I give her credit for because they're very well done and were very well circulated. And if you don't get them from her on the email, contact her because she puts them out every once in a while a week. And so this shows exports of soybean through the P&W. You can see we peak out in that gut period of November, December through January, and then we go to nil, and we've been at nil basically since about March, April. Some stories that we see in the news nowadays, we hear about China buying FOB U.S. beans for October, November. We see here about, of all things, Spain importing U.S. soybeans to re-export the oil to the United States. And in the spring of this year, Brazil became a routine exporter of soybeans to the U.S. East Coast in particular. So this is all about China, no matter how you cut it, it's China. And just to illustrate to you the importance of that, I have a couple slides I want to share you. This shows Chinese import demand. That red line is their imports. Everybody's always trying to question, maybe it's going to peak out, maybe it's going to peak out. USDA has them projected to go at 140 million metric tons by 2030. We'll see. This shows you how important that China is to the United States on soybeans. And once you take away China's soybeans, the next available markets are extremely small. This is off P&W shipments in particular. This is the Soybean Council, shows you the flow of our grains. Again, it's China, China, China. This shows current period imports of China, and the red is Brazil, blue is Argentina, dark blue is the United States. And you can see a couple things. Even though Frayne draws a caution about the future growth rate, they have been continuing to grow since 2012. Brazil is very domineering, those red bars, and the blue bars of the United States are extremely seasonal. This gives just this seasonal picture I want to convey to you because it really drives the bases and therefore your markets strategy. The upper left-hand side, the lower left-hand side shows imports from the United States. You can see that they peak out in November, basically the gut period November through about February, March. Here's current period imports. This shows by calendar year and their monthly imports for all of these different crop years. And the kind of green line, I guess I'll point it to you, hopefully you can see it, that this is the current values of their imports. So number one, these are very seasonal, as you can see, seasonally peaking in May through July. And actually 2023 are very strong compared to other crop years. This is from a friend of mine at McDonald Pills. It's very detailed, but it shows the pace of their imports. Now, when I use imports in the context of this, that's purchases plus shipments. The upper panel of this is their imports by month, the projected demand, how much they bought from the US, Brazil, Argentina, Uruguay, and total. And then you see the number called coverage. So you can see for 2022-23, the top panel, they're 100% coverage. We look into the 2023-24, you can see that they're obviously virtually 94% covered for September, October 38% covered, and then for November through January, they have very, very light coverage. They've only bought in about 10% of their requirements for November out of the United States. So they're pretty light in terms of coverage over that gut period. But take a note here that they bought already quite a bit into Feb, March, April from Brazil in particular. So you want perspective on that, 23-24. At the moment, they're 17% covered. For October, November is 38 and 10% coverage. In the previous years that I have this type of data, they've been for October, November, 61.55, 38.22, 29.52. So you can say they're probably a little bit light in coverage compared to recent years. So there's a futures market, as you know. We had a pretty good peak back in March of 22. We strangled for a while, had a bit of a scare in June, July. And for the last 3 or 4 weeks, we've been sliding longer term. This is shorter term, and Frayne went through this technically before. So one of the things I want to convey to you is about what we talk about carrying charges in the market. And if you've heard me speak, I always talk about this. But one of the most important things in your marketing decision as a farmer, or if you were a buyer, is whether we're in a normal market or an inverted market. So on the left-hand side, this is the futures market. You see the hypothetical values of 8, 820, 835. That means we have a positive intermonth spread. And what the market's doing in that marketplace is trying to induce storage. It's telling you that if you sell for shipment or delivery later time, you're going to get a higher price. So it's trying to induce you to store. On the right-hand side in red, it's called an inverted market. It's an idea that it hardly ever happens, but it's an inverted market. And that what's characteristic there is a negative price of storage. What that's trying to do is convey to you, we don't want you to store. You're better off selling immediately as opposed to later. Now, let me just stop for a moment. I've been teaching this for a lot of years. And when we first used to talk about this, we talked about a normal market as if that is what normally happens. And anything else is very abnormal, which rarely happens. And in the old days, and I'm going to say before 2007-8, I would say probably 80 or 90% of the time we were in a normal carrying charge market. But since 08, 09, I would guess across most commodities, but particularly soybeans, because of the advent of the bi-seasonal market with Brazil, we are in an inverted market at least 50% of the time. Now, there's lots of reasons for that, but it has a very important impact on the decision about storage. There's a pretty elaborate theory on this. You don't have to get hung up on this unless you want to, but this is the theory behind this, invented by John Maynard Keynes, incidentally. And this horizontal is the supply, the amount of stocks in storage, and the vertical axis is that price of storage. And you can see this is the supply curve here. And if we have an intersection of the demand and supply, say at that point there, well, then we have a normal carrying charge market, and it's inducing storage. But as that demand function shifts leftwardly, we get to the point where we have a zero carrying charge, and then maybe a negative carrying charge, and that is what we call an inverted market. So here's where we are today, or over the weekend, Friday, when I put this together. On the left-hand side, upper left-hand side, you can see the price of futures. You can see we're in an inverted market. We're in an inverted market in every single month. So cumulatively, over here, we get the returns to storage and per month. And over here, I give the net return to storage. And ironically, I don't want to say what Frayne must be pretty good, but we didn't collude, but I'm using 12 cents per bushel per month of storage. So what's that tell you? It's a negative return to storage. So if I'm hitting you over the head with a hammer, all this says is don't store the commodity. On the right-hand side, this is the inter-month spread. And you can see back here in about June, we had a positive carrying charge in that market. But since then, for various fundamental reasons, I would say primarily the improving condition, the improving size of the Brazilian crop, the deferred months go down, and that results in the inverted market that we're seeing there today. Okay, so then let's talk about the basis. So most textbooks spend 95% of their time talking about futures as if everything else doesn't matter so much. In my teaching, in my research, in my class, I spend a lot of time on the basis and the interaction between cash and futures market, which is called the basis, and how the rail markets or barge markets influence that spot market or the basis market. So let's talk about the basis. The basis is impacted by delivery charges, by location, time, and quality premiums and discounts. This is my world famous graph, which talks about how we expect the basis to behave theoretically. And so on the horizontal axis, that'd be time. The vertical axis is basis. In harvest time, we expect the basis to be low. And in the post-harvest period, we expect the basis to increase. And the rate of change, in theory, is supposed to be equal to the change in storage cost. So the closer we get to the delivery month, the storage costs diminish and the basis appreciates. Now, it's my experience in studying the basis for many years, and in soybeans in particular, what we more typically have, especially in this part of the country, because we have so many crops that are trying to be harvested and marketed at the same time, more typically we go into harvest and the basis falls very sharply, and sometimes even goes less than the cost of storage. What it's doing there, we have an extremely weak basis and it's trying to induce you to store the commodity. Once that grain is under storage, then the basis begins to appreciate, but it's got to appreciate at a pace faster than the cost of storage in order to induce storers to take the grain out of storage. Now, this is a theoretical behavior, so I have to give that to you, but we quite often don't exactly behave like this, and I'll show it to you in a moment. So here's current values as of Friday. On the left-hand side, these are the offers from Spiritwood from August 3rd. And the right-hand side, I'm going to say from Argyle. And these are from Jim's elevators up there. And I'm not going to talk too much about them, but draw a contrast. Jeff, I'm sure, is going to talk a lot about Spiritwood, so I'll leave it for him. But what I would like you to observe is their bases that they imply in their bids. See, it's minus 50, minus 30, minus 25, going up to plus 15. Now, I know they have changed since I put these on my slide deck, and Jeff can talk about that. But I would say this, that this basis is fairly strong by historical standards and by geographical standards, and it's trying to encourage you to sell, and it implies a positive carrying charge in the basis. That basis goes from minus 50 to plus 65, plus 15. So that's a 65-cent increase in the basis through April. They're trying to induce you to sell and to sell in more deferred periods to induce storage. Jeff can talk more on how they deal with this. I show it to you for discussion. On the right-hand side, in contrast, this would be Argyle, and kind of representative of the Red River Valley soybean market. Now take a look there. In August, they're minus 60, harvest minus 73, and then in January and February going to minus 80 and minus $1. So what are they trying to do? Number one, this says that the basis market is inverted. Just like we have an inversion in the futures market, here we have an inversion in the basis market. Sometimes we even have an inverse in the freight market. So what that is doing is the implied inverse encourages nearby sales and deliveries. They're just trying to hit you over with a hammer on your head saying, sell for immediate term delivery. You can store and sell for deferred delivery, but we're going to pay you a lesser amount. So this spread in the basis market is very, very, very important to drive storage decisions. So if we were to, this is what one of my class exercises, and I make my students and I make them derive the intimate detail of storage, and I'll just share it to you now for a typical Red River Valley using Argyle as an example. And I'm using 12 cents per month storage, which would be interest plus cost of storage. So the first column is for different delivery periods going forward, the relevant futures, and the futures price. So you can see we're in an inverted futures market through the entire duration of that marketplace, okay? And then the basis using current market values is also an inverted. So we're in an inverted market, both in the futures and in the basis. So these would be the relevant cash market values, the spread, the storage cost, the net payoff from storage. And this column here says, what's my best alternative? You can see here the net return to storage. If I stored it into January, I'd get minus $1.05. Not a very good investment. And so this is just, I don't want to heighten the extreme nature of this, but having both an inverted futures market and an inverted basis market is a very important implication for storage decisions. So I'm in our trading room. Some of you have been there before, and we try to have all the information available in the world. And from that, I extract some basis charts that I want to share with you. And I'll share them now. On the right-hand side here shows us all of the data sources that we use and have access to in the trading room. So I focus on the Jamestown area, the Pacific Northwest, and Brazil as comparisons. All right, so here's from MyDTN. This is a free web page, actually. I think it's free, or for us, it's free. So this shows the spatial geography of the bases for soybeans. You can see middle of North Dakota here. We've got some pretty big spreads here between these different locations. If I blow it up, here we're looking at Jamestown, Valley City, Red River Valley here in the -70s range. So you can see quite a bit of spatial variability in this basis value. I'm guessing it reflects the immediate local supply-demand situation and the different expectation of buyers looking forward to the new crop sales, as well as it may reflect their position in the freight market. So here's Argyle. This is a DTN chart for new crop. And you can see that basis back in March of 21 was about 55 under. It spiked up for a while to about -30, went back to 55 under. And then going into our new crop now, it started sliding down to a low of -90. You can see that just about a few weeks ago. And then since then, it's gone up to about -70. I just highlight this. And Jim, these are good traders, and they got a couple of our students working up there. There's quite a bit of volatility in the basis. I mean, most textbooks ignore the basis, say it's stable, don't worry about it. But, just in a few weeks here, we've seen the basis go up 15 cents. I'll show this later on, but this is the MACD chart, just as Frayne showed you, except this applies to the basis. And you can see here, there's a signal right here indicating the basis is beginning an uptrend. And at least for the moment, it's a continuing uptrend. Here's Kensal. So this is north of Jamestown. I used to do Jamestown all the time in my class because Gavilan was out there, and a lot of my students worked there. And we used, for many years, we used Gavilan prices in our class exercises. And then they thought they were smarter than anybody, so they no longer published their prices, and you had to go onto their webpage. And I disagreed with that, but that's life. And so I had to switch it. So we use Kensal now, but this is their new crop basis. You can see that they went up to a spike and a high here in September 21. And then in September 22, they were about -55. So -25, -55. As we go into end of August right now, they're about -80, -85. Now, if you remember, the basis in Spiritwood is -50 or in that area. So you can see why I say Spiritwood is stronger than the geographic area. Obviously, they need grain. So this is Pacific Northwest and Kensal, and this goes from 2015 until current. The top red line is the P&W basis. Quite a bit of volatility there, typically about $1 a bushel plus $1 a bushel, but in 2022, 21, it spiked up here to about $2.50 a bushel. Since then, it's fallen down here to about $1.80 a bushel. Now, I have to tell you that we're all about price discovery and price transparency, and I think Spiritwood is all about that, but not everyone in the world agrees with that. And until recently, we had very good price reporting at the Pacific Northwest. And beginning a couple of years, and then they were reported by AMS and DTN and all of the other agencies, but beginning about 2 or 3 years ago, they no longer reported it for varying reasons, which are not important here. So this data that I show you here is from Thomson Reuters. And so that's the source of that information. But it's a challenge for the industry. And you can see in Kensal here, it's obviously pretty highly correlated, but not exactly perfectly. You can see back here in 2010 or 2018, we had a crash in the basis, but it fell much more in Kensal. ADM is one of the few companies in the world that publishes detailed information on the basis. I think this is a sheet that's sent out to their suppliers. Jim shares it with me as I use it in my educational purposes. And I think it doesn't offend anything to do this. I use it for teaching. And I want to highlight to you today that the alternative markets here are primarily the Pacific Northwest and St. Louis. And people always ask, why don't you go to St. Louis? Well, here's the reason why. Look at that basis goes down to minus 5 cents versus P&W at 180 for new crop delivery. So just about always, and every time I teach this, P&W dominates St. Louis by a huge amount, like 50 or 70 cents a bushel. So you can see that base is pretty flat, but also inverted here. You can see 185 going down to 160 for December. So that's an inversion in that basis market. Here's a graphical picture of it that I showed you earlier, but I want to contrast that to a year ago. See the bases, my pointer here is 185 currently for 180 for October. A year ago when we taught this for October, it was 215. So this year's basis is 40 cents under a year ago at the market. I'm guessing it is completely reflective of changes in ocean rates and the more large supply, low basis situation in Brazil, which I'll speak to in a moment. So I want to talk about Brazil. You know, you guys in soybeans, Brazil's our major competitor. China needs both the United States and Brazil, but we compete and we compete seasonally. But what's happened in the past few years is their logistics has improved. Their production has increased in 23 pretty drastically to record high. 2024 is expected to be comparably larger. And the implication of that is Brazil can be more competitive with the United States further into the US marketing year. So here's data from AgriSenses. This is the Brazil basis compared to the US Gulf and P&W. So let me highlight these going back looking at 2020. You can see in this area here, this green and yellow, that's the basis at Brazil. So you can see sometimes they're higher than us, sometimes they're lower than us. They're lower kind of seasonally than we are. This red line is the US Gulf, and the purple line is the US P&W. Going into this current crop year, since 2023, because of the large size of crop in Brazil, their basis fell very sharply. Look at that basis. When we talk about volatility of the basis, that basis went from about $3 a bushel to minus $1.50 a bushel. That's a $4.50 a bushel change in the basis in a relatively short period of time. I think reflective of the large crop that they have there. You can see that has the effect of pulling down or putting pressure on our bases at the Pacific Northwest and at the US Gulf. Now, in recent weeks, their basis has increased pretty sharply as they start approaching the end of their old crop shipping season. If we look at the forward curve on the bases, and this is a pretty important punchline for you farmers as you plan looking into the new crop year, this is we have a forward curve in the futures market. We can have a forward curve in the bases. Now, this blue line is the forward curve at the US Gulf. Red line is Pacific Northwest. So you can see the US Gulf there is about plus $1, but pretty flat. I mean, there's not a lot of radical volatility in that basis going up to 6 months forward. But when we look at Brazil going up to 6 months forward, so this means that their basis is going higher. That's through about October, November. And then it begins to crash into December, January, February, March, April, May. And that crash is the result of their approaching harvest season in January, and they expect it to be large crop being harvested. You can see that basis falling from a high of about $1.25 a bushel to minus 50. So that's $1.75 change in the basis. And I'm sure Frayne would say this, and I would say it, that's a very drastic impact on our bases. The connection is that puts downward pressure on our Pacific Northwest bases, which puts downward pressure on the bases in the interior of North Dakota and Minnesota. And that is why when we're all said and done, everybody's going to say, be sure you sell your crop before we get into January, because then we start feeling that downsliding basis. So here's a seasonality of the bases in Brazil. On the left-hand side, this is their average. You can see their bases reaches a low in about April and May and peaks out in about October, September, and then falls sharply. On the right-hand side shows the different crop years. This blue is the longer-term average across crop years. You can see that seasonality peaking in August and September. And in this current crop year, that's this one right here, if you can see it where my cursor is. Okay, so that was very low in April, and it's increased pretty sharply, but it's still about 75 cents less than normal. So their basis is a lot weaker than normal, I'm sure reflecting the size of their crop. The fact that they have a weak basis puts downward pressure on the U.S. Gulf and U.S. P&W bases and our interior bases. A big thing about Brazil is they've historically had poor logistics that resulted in not enough storage, not enough handling, not enough freight, not enough anything. But over time, they've improved their logistics substantially. This chart, I had a student do her thesis on this. It shows the average wait time, in this case, at the Port of Santos, which is their biggest export port. You can see compared to back in 2013-14, where those wait times were 25 days. In more recent time period here, it's only like 5 days. That's a big problem for us as a competitor. So freight has a big impact on the bases. I'm not going to drag us through this too much because there's a lot of detail, but the rail secondary car market value has a big impact on the temporal behavior of that basis. This is the secondary car market values for freight on the BNSF system from 2015 until current. You can see we had periods of high spikes. We call it DCV, daily car value. But since about last July, where we had that big spike up to about 2,500, the values have fallen pretty sharply. And now we're routinely in the spot position negative. Well, that's the impact of improved rail performance and reduced export demand, primarily. Here's the current market, and you can see as we look into August, September, we have negative values in that freight market. And that's why it's fairly attractive for selling into August, September, October period. As we get out into these out periods, the market inflates quite a bit. Now, compared to historical values, these October peaks, these October values are still lesser than normally would be the case, but you can see a pretty sharp increase from August, September going forward. All right, so just briefly, I want to talk about risk of different types of contracts. You all have alternatives of using futures or basis contracts or other types of contracting. I just want to emphasize an important point. And normally when people talk about market strategy, they talk about the risk in the futures. But we have quite a bit of risk in the bases also, and the bases and futures are correlated. So I have a model I use in my class to depict and show this. It's a spreadsheet-based model using DTN prices, and this is applied to Courtney, I believe, North Dakota. So these are their actual prices, futures, and their local price. And down here is the spot basis at Courtney. So you can see quite a bit of volatility in that basis. We measure volatility using the standard deviation, specifically a 21-day moving standard deviation. The red line is the standard deviation for futures. The blue line is the standard deviation for the bases. You can see back in May, the futures volatility was far greater than the basis volatility. But then in July, their volatility was just as great. What that meant is that the basis risk was as great as the futures market risk. Now, in the recent couple of days, the futures become a little more risky and the bases become a little less risky. But that basis and the futures market are correlated to each other. And this shows that moving correlation back in May was like minus 0.8. So that's a really strong negative correlation. And currently it's lesser, but it's still a negative correlation. So in our model, if I were to measure profits and risk, here's what it is. So this would be a Jamestown area farmer at 50,000 bushels and a cost of $239,000. And when I did this over the weekend, the basis was minus $1.99. That was a Courtney, futures of 14.44. those are nearby, so it's not really new crop. I didn't adjust for that. You can see the bases, standard deviation is 19, futures is 34, so bases risk is important, and they're negatively correlated. So if I were 100% hedged, my profit would be $382,000. Standard deviation would be 97.42. 97.42, that's our measure of risk. So even though I'm 100% hedged, I still have risk. That is the risk due to the bases. Last year when I taught this, that standard deviation was 12,000. If I were 100% unhedged, my risk would be $17,844. Notice my profits are the same, but the standard deviation of profits is twice as great, basically. So by hedging, I reduce my risk, in this case, by about half. Now I have an optimization in there that determines that in reality, one of the best strategies right now for reducing risk is being 50% hedged in futures and 50% hedged in the bases. It puts that standard deviation down to $8,900. And that's because of that correlation, that negative correlation between futures and bases. All right, so people want to ask, how do we analyze the bases? There's two things I do is use the MACD, which Frayne talked about, and using seasonal indexes. So here's MACD and Argyle. You can see that we're in an uptrending market, basis market, commencing from a few weeks ago. And similarly, Kensel, the base is uptrending from about mid-July, just slightly. And we also calculate seasonal indexes. So here's Argyle. Left-hand side is long-term average. Right-hand side shows individual crop market years. So for some reason, Argyle gets a spike in the bases in July and then falls through October. And then it stays there through a peak in January, and then it falls off on average. 2023 is about 30 cents greater than normal. So normally it'd be minus 90, but it's actually about minus 60. So base is stronger than normal by about 30 cents. Here's the same thing in Kensel, not exactly the same. We get a bottom in April and May, and then the basis increases through December, January, and then crashes. Very, very typical. 2023 is about 10 cents greater than normal. All right, so here's my depiction of alternative marketing strategies. We can use basis contracts. It really depends upon how we expect the futures to move and how the basis is going to move. I highlight in yellow below, probably the most likely scenario this year where futures are probably going to slide some more for the reason Frayne discussed. And basis is probably going to be trending upwards slightly. So the best strategy is probably HTA contracts or selling futures and staying along the basis or buying puts. Okay, in summary, I give a near-term outlook on the left and longer term on the right-hand side and the factors that are going to impact it. In the nearby, in the period of time, November, January, the fact that we have an inverted market is important because if all of you begin selling soybeans off the combine, that's going to accelerate farmer selling. It's going to put downward pressure on the basis. So that's going to prospectively have a further negative influence on the basis. If we have an increase in rail secondary market values, it might have an impact. And if we have a lack of further P&W purchases by China, it will have a negative impact. On the bullish side, we have seasonal increases through January. If we have crop problems in the United States, if the secondary market value changes. Longer term, looking January forward, the most important thing is what happens in Brazil. And besides Brazil, we have dramatic decreases in the basis seasonally January forward. And if the crop in Brazil becomes larger, put further downward pressure on that basis. So with that, I will stop sharing, but I'd be happy to try to answer a few questions if you have.
I just realized you all can't hear me. I don't see any questions in the chat, Bill. We don't have a whole lot of questions this morning, but I think everyone's just soaking it all in.
Can you share the contact for getting on some of those distribution lists that are happening if we had interest in following some of that?
Jenna, I referred to your export, your weekly, or what used to be weekly email, and used that and gave you a lot of credit.
Yeah, thanks.
And I think you should share that to them. That's what he's referring to.
Sure, I can I do that monthly, and I've typically done it for our board, but I'm happy to share that information with anyone. It's kind of a roundup of what has gone out of the PNW the last month, and kind of what's gone on in soybean news in the last month too. So if you're interested, I emailed all of you yesterday, so you have my email. Anyone that's interested, just send me an email and I'll get you on that list. Any other questions? And did that answer the question that was posed?
Yes, thank you.
Yeah, no problem. All right. With that, we have Jeff Gruss. And Jeff, am I saying your last name right? I meant to ask you that before we started here.
It's actually pronounced gross, but that is no problem. We get that a lot. We're okay with it.
Okay. Well, my last name is Bjertness with a BJ, so I'm very, very aware of the mispronunciation of last names.
Yes, I would imagine so. Let me try to share.
Looks good. We just need you to.
Yeah, let's try to get here. How about that?
That looks great. Well, with that, Jeff is a senior merchandiser at Green Bison Soy Processing, which is, he's going to go into detail about this, but Green Bison Soy Processing is that joint venture between ADM and Marathon that will be our first soy dedicated crush plant in Spiritwood, taking beans this fall. So we thought it was very important to have someone from Green Bison do our industry perspective, given that it's a very momentous fall for them and for us as soybean producers in North Dakota. So with that, Jeff, I'm going to hand it over to you, and I'll have you get started.
Yes, thank you, Jenna, and of course, everyone for having us on here. We're excited about the opportunity to, be the first to be a crush facility in the state of North Dakota. And I think kind of everyone's so far presentations has kind of helped tee up some of the positives that a crush plant here running for 12 months out of the year can do from a price perspective for North Dakota soybean farmers. So we're excited to be here and appreciate being here. So thank you for having us. I am Jeff Gross, senior merchandiser for Green Bison Soy Processing LLC. We keep laughing because I'm new to the team and new to North Dakota and learning what bison versus bison is. Just trying to be a little bit more transparent with where we're at and pronouncing it correctly. So I'm still learning that. I started with Green Bison here in June. A little bit of background about myself. I've been with ADM now for 10 years, bounced around at a few oilseeds processing facilities in the Carolinas, Nebraska, then was in Decatur at our corporate headquarters, trading our animal nutrition commercial feed facilities, the macro ingredients into those facilities. And then most recently, the corn into our wet mill in Southwest Minnesota, Marshall, Minnesota. So let's see if we can't get the slide to change. There we go. I now office both in Fargo and Minneapolis. A lot of this presentation is more so geared towards who we are rather than, some of the strategies that we're implementing. I think a big piece of what we're trying to do is get our name out there and understand that we'll be, demand for soybeans in a big way for North Dakota, and increasingly so as Castleton and Grand Forks potentially come online as crush facilities that will ultimately, change the lens that is soybean marketing for North Dakota in a way that hopefully can help us get more for our soybeans that are raised here in the state. So Green Bison Soy Processing LLC is a joint venture. We're 75% ADM, 25% Marathon Petroleum Corp. It was a $350 million project that began June of 2021, and it is located at the brownfield site that is the old Cargill malt plant in Spiritwood, North Dakota, sharing the Spiritwood Energy Park with Dakota Spirit Ag, the corn plant, and Great River Energy, the coal and natural gas plant in Spiritwood. So a lot of what that site offered to us is, an industrial site that has a lot of space, but also the ability to, work logistics in a way that hopefully can best capture efficiencies from a cost perspective into the plant and make it as easiest as possible to deal with us from a purchasing standpoint on my end and the team's end as we look to take on as much soybeans from North Dakota as we can. So our crush capacity, you can go Google, a lot about the early goings of what we're trying to do. We will be processing 150,000 bushels a day. And so using last year's yield of 35 bushels per acre, that's about 4,200 acres worth of North Dakota soybeans in a given day. That won't happen, right away. Our plant is commissioned to start in the early goings of October with harvest activity happening in full force, hopefully. We've got ribbon cutting for kind of starting to get the plant into our hands so that we can use it for the last half of SEP. And we're excited to hopefully be able to, start taking beans on somewhere towards the end of September, having the facility run in early October as well. But ultimately, 150,000 bushels per day, something in between 50 and 55 million bushels per year to be crushed at our Spiritwood plant. And so I ran a quick calc versus what production was for the state here last year, and 50 million of 200 million or so, about 25% of what North Dakota produces for soybeans could be used here by Spiritwood if we can manage it appropriately and have a 12-month supply of soybeans for us. So a lot of my pitch here today is, we'll be here 12 months out of the year. I think the other competitors getting into the space will say the same thing. We're very much willing to show a carry here in flat price bids to the farmer, as we hope that, we can provide an outlet for 12 months out of the year for beans rather than more so an export window, as Dr. Wilson has talked towards in a big way. And then the market as a whole. But in terms of, August 7th crop progress, Frayne captured it pretty well. We had North Dakota at 43% good to excellent. So that 35 bushel per acre yield, just hoping that, we catch some August rains. It looked like a big piece of our draw territory here this past weekend caught anywhere from a half inch to 3 inches of rain. And so we were excited to see that here, as beans tend to be made in August. And we'll hope with, the next 7 to 10 days, catching a few more rains to help finish out the bean crop to help originate soybeans for the plant going forward. But our main products at the plant will be refined and bleached soybean oil. We will be sending all of that to Marathon Petroleum Corp in Dickinson, North Dakota, where they will further process the oil into renewable green diesel. We then will have soybean meal, which is more so my job and Jess as merchandisers trading the logistics around soybean meal and trying to find the best outlet for the protein demands that can supply going forward. And then, of course, soybean hulls as well, pelletized hulls into mostly cattle markets, hoping that we can, start to help develop livestock sectors in the state so that local demand can help to take a lot of what's coming off the plant here going forward, because it will be pretty significant volumes that we'll be looking to sell on the back end of the plant as well. So that's a little bit about our setup and who we are, but our team is comprised of 6 of us, Mike, Jess, and I are kind of more so the commercial merchandising side of things. Mike's my boss, who sits in Fargo, Jess as well. We will be trading the meal and the fiber, and then more so commercial beans, but ready to take on the phones as the market persists. I'll kind of give contact info from an 800 number that reaches us as a whole, but also take note of that GBSP at greenbisonsoyprocessing.com. If you email that, we can get you, that'll go to all of us, and we can get you set in whatever way you might need, whether it's being a new vendor or things of that nature. It will help us to get the system set up in a way that we can best do business with you in the most clean and efficient way possible. So take note of that GBSP email address if you have interest in contacting us further, or me as well. Then we have Shauna and Justin Sorby, who are in the Jamestown area. They will office out of Spiritwood once the site is ready to house employees. I'll have some pictures here shortly, but we do have a pretty significant construction site going on with all hands on deck, trying to get the plant ready to go for fall harvest here going forward. And then Jamie Davis will kind of serve as the liaison amongst all of us as we best try to pay out basically ticket info and things of that nature, getting soybeans into the plant. So I'll have kind of more so the 800 number and everything as a summary screen. So take note of that. We're happy to field whatever questions you might have from us here going forward, but that's a little bit how we're set up as a group. So here was the old Cargill malt plant at the end of June. I'm learning there's been a lot of thoughts around what the plans were for this facility. And of course, ADM took it on at the end of June. And by the first year going, we, as you can see, demolished a big piece of what the existing infrastructure was and started to erect steel for extraction and our prep buildings. Carrying that out through May of 23, you can see the progress that we've had. A lot of cars on site because it's really starting to become go time in terms of getting things ready to go here for the plant. And then most recently, just a few different aerials. You can see on the left-hand side here, kind of more so our meal and bean unload locations, some meal storage, bean storage, and then on the right-hand side, extraction continuing to take shape, of course, with now, about a month and a half before we really want to try to start get things going. So exciting stuff for us. We're, looking forward to bringing kind of a lot of eyes, especially from an ADM perspective. It's kind of the shiny new toy in adding a crush facility to our group. And it'll be good to be able to tag that into the greater system that is ADM as a whole. So here was just a quick, summary slide of SAM, the soybean, for what we do. I won't necessarily go through the entire process, but this is a good one that we have for, high school groups or FFA communities as we try to teach a little bit about what we do. But we take in beans, clean them, condition them in a way that dries out the beans so that we can crack and dehull the shell off the bean for fiber purposes in the form of pellets. We'll then flake and extract by adding hexane to the flake to extract the oil off. That way we can segregate the protein space that is soybean meal through the DTDC over on the left here. And then crude soybean oil on the back end of the plant, where again, we'll produce refined and bleached oil to then send to the Dickinson, North Dakota facility with Marathon to further process into renewable green diesel. So general production, these are rough numbers, and so just give you a little bit of an idea as to what we're producing on the back end of the plant. So 150,000 bushels per day times a 44 pound per bushel of yield into soybean meal produces 6.6 million pounds of soybean meal divided by 2,000. That's 3,300 tons of soybean meal per day, or the equivalent of what rail cars will be about 33 rail cars per day. So a lot of how our system is currently set up, of course, we'll try to sell the soybean meal as merchandisers to the highest bidder first. And in that way, try to take advantage of freight opportunities in shuttle markets out of the soybean plant into mostly the P&W. But, if ever different arbitrage opportunities happen or freight spreads tell us to do so, we might be sending those rail cars all over, the U.S. destinations going forward. So 11 pounds per bushel oil yield, 3.5 pounds per bushel soybean hulls is what we kind of are going to be producing. So soybean meal, protein source and animal feeds. We hope to be offering kind of 47% protein soybean meal into export markets that will hit destination marketing in Southeast Asia, but then, any sort of livestock industry you can think of, domestically as well. Tyson and Pilgrims are kind of some example customers that we have as an ADM network that are taking on protein into poultry markets, specifically from a rail car perspective. So a lot of what we're also trying to help preach is, this will be consistent supply from a protein side of things. And so livestock sectors in the area certainly don't hesitate to reach out, and we will look to get you set up so that we can sell you some of these products as well if you have interest. But again, oil feedstock for the Marathon refinery in Dickinson, North Dakota, renewable green diesel, and advanced biofuel that reduces greenhouse gas emissions as a clean burning fossil fuel replacement, and a less carbon intensive process that Marathon has committed to. I just included a little bit about what that facility is about in Dickinson, having converted it from a petroleum plant into a renewable green diesel facility going forward. So that's kind of the different products that we have and where we hope to be able to market those offerings to the market. My background's a little bit more so the ADM side of things, and largely the plant is going to be run with, kind of more the expertise that is ADM as a soybean crush facility, on our end within the ADM system. So the way ADM is set up is we have three different groups: egg services and oil seeds, carbohydrate solutions, which includes more so your corn and wheat milling, and then nutrition in the form of human nutrition, animal nutrition, and health and wellness ingredients. So our network is 40,000 people strong kind of across the globe. And what we'll look to do is take advantage of kind of the existing system that we have out in place that we can best be set up to try to, look to, both take on soybeans, but also sell the products into from a marketing perspective. So a lot of our, role as a group, of merchandisers is managing the transportation needs from a rail perspective, truck perspective, and running the plant with hours, accordingly, so that we can best take on beans in a way that works best for those that do business with us. So ultimately, our customers are in every sector: food, feed, fuel, and industrial capacities. So a little bit of what our North American soybean crush facilities look like. You can see our existing network kind of spans mostly as far west as Nebraska into then Kershaw, South Carolina, which is where I started. And depending on how, freight aligns, these different markets are able to hit different sectors of the industry. And Spiritwood will tag in a way that we can best try to take on all of what we will produce from a soybean meal perspective, but also use our network to understand, beans as a whole, and hope to do, buy it a little cheaper than maybe the competitors can, just given, our place in the market. And for me, it was a good exercise too, to go through, North Dakota hadn't had a whole lot of eyes on it from an ADM perspective. Now with Spiritwood coming online, it's adding a lot of focus into North Dakota as a whole for what we already have. And it's actually surprising to a lot of us to see what all is out there existing within the, the state already. And a little bit of the advantage will be that we have a lot of data out there already that can be transferred into Spiritwood's. We call it the data set, so that we can conduct business most efficiently for things going forward. You can see a few of our JV country elevators within the ADM regional footprint, Benson Quinn. I actually am sitting in that office here today with, our Mankato oilseed processing group, but also the shuttle folks, in a way that we can, share information and try to find the best outlet for North Dakota soybeans, whether that's the PNW or a crush facility locally. Ultimately, we're just trying to find the best market for all of these products. Country elevators, though, Heber and Hensler trading office, which is where I will go, most weeks, and then Mike and Jess are also in the Fargo office at our specialty commodities location in West Fargo. We have oilseeds crush facilities in Enderlin, Spiritwood, and then Velva, North Dakota on the canola and sun side, and then edible bean locations in the locations below. So just interesting to see that, there's a pretty big presence kind of for ADM already out there. And we'll look to, pair up logistics in a way that can best help serve all of those different locations as we try to, take on the new plant for what it is. So just a, quick bean production slide. We had the planted area and acres report come out towards the end of July. That, we were actually, at the end of June, showing 5.65 million acres of soybeans here for this crop year. And then just a ranking of soybean production by state, North Dakota coming in at 8 for last crop year. So hopeful that, yield implications can maybe help things versus a 35 bushel per acre yield, but also, trying to help incentivize carry in a way that will justify maybe planting a little bit more soybeans as the crush facilities continue to come online, with Spiritwood starting that here for harvest this year. So one thing that will be important, and this doesn't necessarily need to get anywhere other than, new grain vendors into Spiritwood. If anyone's on here with interest, give that email address a shout and we'll reach out. We can set you up with bid and text distribution lists for our daily bids. You can get that as much as 3 times, but also if you're set up prior to us commissioning the plant for startup, we can best take on beans in a way that hopefully can get you more for them coming out of harvest here this year. So get in contact with us. We will be very happy to see that come through. And then we'll have you set up and ready to go via communication from our team that can help us to take on beans here for harvest this fall. A lot of we went for a see for yourself group, went out to the PNW to, see key stakeholders with the Soybean Council, North Dakota Soybean Council here at the beginning of July. And a lot of the questions were against kind of the discount schedules for both us and Castleton. I just grabbed ours quick to show you mostly the moisture discount that we start at, which is 13.1. We will dry that further down for the best efficiencies within the process, more towards a 11% moisture soybean as we take those on. So get in touch with us. Again, we'll get you discount schedules and things of that nature that can help you make decisions against, things as you market your grain going forward. Lastly, we've kind of touched on in a big way through Frayne, Mark, and Dr. Wilson against, our structure in the market and what we're trying to do. It was good to see the August 4th bids out there through Dr. Wilson. We were 50 under at the time. We firmed up 5 cents here nearby to 45 under for new crop. And then versus Argyle, just trying to show our value. Argyle at 73 under, less of 45. We're, paying 20 to 30 cents better than what country elevator systems here are paying currently, to try to help incentivize sending things our way, as we further process the soybean into those different products, trying to derive value out of those products. So again, we are showing that carry rather than an inverted market through, first quarter of next year. These were yesterday's bids, 12.57 out to July 13.41, showing 84 cents carry into the summer months for next year, trying to help, show that we'll be there for 12 months. And of course, 50 million bushels to take on of 200 million in North Dakota. We've got a pretty tall task in front of us as to how we keep the plant supply going forward. And hopefully it can help kind of change a little bit of marketing programs here, rather than more historically storing corn for the summer months. Beans can be a part of that conversation as well. And we're willing to show that via bids out forward as you might have interest. So I don't have a whole lot more than that. It was pretty quick run through. Thank you for having us again. My contact card here, don't hesitate to jot it down. My mobile number, you can reach me directly, but also we're all on that 800 number kind of ringing around the horn. And so if you have interest, please don't hesitate to reach out. Also, that GBSP will get us as a group as well. Again, thank you for having us, and we look forward to continuing to learn a little bit more about what we can't do with North Dakota soybeans here going forward.
All right, thanks, Jeff. As Jeff pointed out, we are about to have an awful lot of soybean meal coming out of North Dakota. And if anyone on this call is interested in diversifying and getting some pigs on their operation, boy, do I have some contacts for you. Because we are about to make an awful lot of soybean meal in this state between Spiritwood coming online this harvest, and Castleton intends to be coming on, I believe, next harvest is last I've heard, and we have other prospective plants as well. From someone that has been following the progression of the soybean industry in the past 3 years I've worked here. When I started, we crushed 0%. Maybe, as you said, Jeff, we have the ADM plant in Enderlin that did soybeans sometimes, but really, for all intents and purposes, we crushed 0% of our soybeans. And if we've got 2 crush plants coming on, we've got a third one trying to, if all 3 come to fruition, we could crush up to 70% of our soybeans in the next several years here. So that's pretty wild for soybean growers, and we're wanting to make sure that we keep you all informed with how that evolves. That's why we have Jeff here today, and we continue to work with these crush plants along with the elevators and all the other channels our soybeans are going through. So any questions for Jeff about green bison processing? Got the chat pulled up here and I'm not seeing anything. Obviously, if you're local, as Jeff said, you can reach out to them to get an account set up and go from there. Otherwise, thanks, Jeff. I think we may move to our break. We're just a few minutes ahead of time. Let's see, we're about 8 minutes ahead. So, Mark, we've got you on here. Can we start at 10:55 rather than 11?
We can start whenever you're ready.
That sounds good. Why don't we take a break here and we'll come back at 10:55 with that weather update from Mark Ewens. And if you have any questions for any of our presenters, they're still online. So I'm watching the chat, and just feel free to get in contact with one of us and we'll get that taken care of. See everybody back here at 10:55. Mark, if you're on, let's get your slides ready if you are able.
I can do that. Let's see here. Launch this thing. Come on. All right. I got to share my screen. Let's see.
Should be able to.
Okay. How come it disappeared on me here? Oops. Let's try this. Maybe if I started my video and then went to share screen. Okay. Now, do you see me?
I do not.
Huh.
Let me see.
Okay. Well,
You should be able to.
yeah. Let's go. Okay. Let me try screen 2. For some reason, it wants to share to screen 2.
I can't see your video either, Mark. I'm just
Really?
seeing your name.
Well, that is odd.
Nope, your video might be starting now. Yep, now I see your video.
Okay. Let me try that one more time. Maybe I didn't hit the button hard enough. Okay. Do you see my presentation yet?
I do not.
Okay. It's like it wants to put it on screen 1.
Let me do this. Okay, we see you. We just don't see your slides. And I have your slides, so if you're...
Well, no, because while they were all talking, there were some additions I put in there because I knew that they would ask questions that, okay, let me try this. Any luck yet?
I do not see them.
Ah, geez, come on. Seems like I had this problem last time too.
Looking to see if there's something I can click. I'm gonna make you a co-host. Let's see if that makes it easier. Okay. Hey, there we see something. All right. If you start your slides there.
How's that?
That looks great. Looking good.
Okay. I just had to move. I have a 2-headed monster, and for some reason it insisted on putting it on screen 1, even though I had designated screen 2. So I just moved it over.
It looks great now. So Mark Ewens is meteorologist at Home on the Prairie Weather and on KNOX radio. And so Mark has done this. This will be, I believe, our 3rd year, Mark, of you giving our weather update in the mid-season market outlook. And so I haven't kept track of, your percentage of being correct, but and I'm not going to start to today, but I'm sure it's been great.
Good.
And so with that, Mark, I'll hand it over to you for our weather update.
Okay, thank you very much, Jenna. I can also send you a copy of the updated slides. As you folks were talking, I'm thinking, oh, I should have thrown that in there. Oh, I forgot about that. So there's a couple of additions that you don't have. Quickly, for those of you who I have not met, I am this old. If you know what that is, congratulations. In my former life, I was the cooperative program manager of the National Weather Service office in Grand Forks, from which I retired in November of 2014, was picked up by KNOX in the winter of 2015 to be their staff meteorologist. This is a cotton region shelter. I'm sure most of you know what this is. And this is a very fancy cotton region shelter because of the double-decker top that it has. I serviced equipment like this for much of my career with the Grand Forks Weather Service. Some facts and some figures. And again, if I go too quickly or say something you don't understand or otherwise babble, please make sure to raise your hand and ask for clarification. Anytime we talk climate prediction, we must talk climate change because it is a part of the process. We also have to talk scale because we look at climate on numerous scales, from the macro scale, global, down to the meso scale, and they all feed back into one another. The image on the left is the cool season, the meteorological definition, October through March. And this is the difference of the 20 years from 2000 to 2020, subtracted out 1980 to 2000, and it essentially shows what we already know, warming over a large part of the United States, North American continent region, but interestingly also shows a little cooling in parts of the southeastern US. The right side is the same thing, but it is the warm season, the summer. And what is perhaps most interesting about the summer season is the relative cooling over southern Canada, parts of the northern plains, and a few spots elsewhere. But of course, the net temperature change has been up. Now, I talk about scale because these are the same years, but using a higher resolution data set. And you can see the significant difference that shows up in some of these areas. The cooling becomes more pronounced. The warming areas have cooling areas embedded in them, which are typically associated with increases in precipitation, because as you warm the atmosphere, and sidebar, from the meteorological standpoint, the most potent greenhouse gas is water vapor. It fuels the storms. So as we warm the atmosphere, more water vapor, more storms. So we're seeing the atmosphere behave the way that we expect it to. But when the high resolution data, we see the significant overall increase in summer precipitation over the southeastern United States and parts of the northern plains, including the Red River Valley region, and generally variably mixed changes over the northern plains and the Ohio Valley. And I mention the Ohio Valley because it is strongly influenced by the ENSO. Looking at kind of a close-up here, these are the trends. Again, same season, using cool season on the left, warm season on the right, with a 2.5 degree grid. Just kind of gives a little zoom in of seeing these changes. And again, the Red River Valley is interesting because in the summer, warm season, we have seen these relative increases in precipitation. Of course, not consistent with the drought going on over much of North Dakota, but we would say that as we move forward in time, we'd probably see more wet periods than dry periods. And again, just a close-up looking at the 2.5 degree grid season temperature-wise. Okay, climate divisions. This is how we do climate in the Weather Service, by division. And when I'm talking about the Red River Valley, I talk about North Dakota climate divisions 3, 6, and 9, Minnesota divisions 1 and 4. The 42 counties that show up in this graphic are the Red River Valley. They basically have very similar topography. Of course, Logan, McIntosh, Lemoore, and Dickey, they're technically outside the valley, but climatologically, they are relatively similar. And as anyone who lives in the area knows, there's a slight difference between the weather in Halleck versus the weather down in Yellow Medicine County. So, but this is climatologically over the long period of time, the weather is essentially the same. Again, climate versus weather. Now, this graphic is the Red River Valley, those 42 counties that I showed, looking at the entire period of record using the substation network. I showed the Cotton Region Shelter at the beginning to indicate that most of the data that is in these presentations comes from the Cooperative Weather Network. We have quite a few stations within the Red River Valley that are very old. University of North Dakota / now National Weather Service office is one of the older climate stations within the Red River Valley with data back to the 1890s. This is the temperature data, and we can see the change in temperature, the yearly data, a polynomial curve, and a 7-year running mean in blue all show what we expect to see. A warming period. We had the mid-century dead spell, as it were, called several different names, where the climate remained relatively stable from a climate standpoint, but some pretty big variations in temperature across the region. Then as we got into the 70s, we started warming. Now, most interestingly enough, at least in the Red River Valley over the last roughly decade, 12 years, our temperatures, although the variability is obviously still fairly strong from year to year, the mean temperature has remained approximately the same. We've warmed from roughly 39.8 degrees at the beginning of the data cycle to about 41.5. So the warming is obvious there. Same thing quickly with precipitation. Precipitation through the Red River Basin, extreme variability from year to year. You can go from one of the drier years on record to one of the wetter years the next year. That's very common because convection drives much of the variability in the climate. So when I talk these climate outlooks, we have to keep that in mind, that there's going to be a lot of variability that's difficult to catch. And again, if I go too quick or say something that you don't understand, or you go, huh? Please ask, because I want to make sure that I am as clear as mud. The climate recap since last fall, I think what we all know, and this is information from the North Central Climate Region Center down in Lincoln, Nebraska, University of Nebraska. The departure of normal temperature from the 1st of October through several days ago, really in the long term, we've been on the cool side of normal. Of course, we've been quite warm. But again, when looking at climate, we have to talk about different periods of time. Same thing for precipitation, very dry. Of course, that's how we've gotten into the drought situation that we're in. I think most of you are very familiar with the wet cycle, as it were, the mini cycle that's set up during the spring with consistent moderate to heavy rainfalls at the Front Range and in parts of the Intermountain West during the late winter into the early spring. And despite our record snowfalls over the winter in parts of the northern plains, we still ended up below normal with precipitation throughout that entire period. It's very interesting. Again, since last fall, the departure from normal temperature now looking, and I said last fall, but this is technically since the beginning of the warm season to where we are. We've obviously done a flip where we're much warmer than normal, and of course continue dry in the Red River Valley. A couple of spots, and again, this is where convection becomes important, where excessive rain falls. I think this is the Mavie Endon site over there east of Thief River Falls that received extremely heavy rains in one rain event, and that's how that biased that little dot there, and some heavy rains in the Devil's Lake Basin as well. So again, these are all part of the natural variability within the climate system. I think this was shown, Frayne, you talked about this. One of the things that I look at as well is the Vegiscape graphics, the information that comes via satellite. So I won't spend much time on that, because the way to get an idea of a climate snapshot, I look at these as well to see how things have changed from one year to the next, to get an idea of the intensity of the drought. What the Weather Service deals with mostly, and it is a multi-agency entity, but the Weather Service is the front end. I think we've all seen the U.S. Drought Monitor. This is the last one from August 3rd, showing the drought through much of the Plains region into the Red River Valley. And I don't think there's a need to really belabor much on that. But again, one of the tools that we look at, because if we see something locally, now that I'm a member of the media, I can reach out to my cohorts, my former colleagues at the Weather Service, and say, hey, what about these areas? So these are very much a multi-agency map put together by our friends in agriculture, Daryl Richardson at NDSU with the Endon Network, Adnan Accuse, the state climatologist. There is a multitude of people who go into putting these graphics together. So this takes a lot of time to foment these. We've got some new tools as well, and these are relatively new if you're not familiar with them. The Evaporative Demand Drought Index, because we're finding more and more ways to look at drought and to categorize it. And the EDDI uses atmospheric evaporation demands, anomalies over different timescales, 3 months on the left, 6 months on the right, just to give us an idea of exactly how much evaporation is occurring or how much surplus precipitation is occurring. And again, the residuals from the very heavy rains up the lee of the Rockies shows up in both images. Obviously, there has been a decrease in the wetness, which shows, again, the way that the drought is developing. It uses the old Penman-Monteith maybe that's not so old. Penman-Monteith reference evapotranspiration formulations is a part of it. And it's also run by the North American Land Data Assimilation System, which is a relatively comprehensive numerical modeling program run at the National Centers for Environmental Prediction and the Climate Prediction Center. Another tool, the groundwater and soil moisture conditions from the GRACE satellite. I know that's part of what goes into the veggie health, I do believe. So we can look globally now and get an idea of where the soils are, where they've had excessive precipitation. So for example, Northern Australia, which was coming out of a wet cycle and expected to go into a drought, remains very wet. We know that portions of China have received excessive rainfall, and yet there are still areas within that region that in the long term are dry. So again, we're looking at multiple timescales and how they overlap with one another. Now, getting into the heart of the matter, sea surface temperature anomalies. This is the global sea surface temperature anomaly map based on the CDAS system, which is, again, is a multidiscipline system run at the National Centers for Environmental Prediction in conjunction with a whole host of agencies, including the Japanese, the Australians, the European Space Agency. And these are fairly high resolution images of sea surface temperature. Now, underlaid very faintly, you can see the ENSO regions, ENSO 1.2 right amidst the South American coast, Nino region 4, and Nino region 3.4, which is what we focus on the most for declaring El Nino or La Nina. And it's interesting because there are different types of ENSO events that I'll get into it here shortly. What we're seeing too is the very cold water in the kind of the southwestern Pacific region. This is part of something known as the negative Pacific Decadal Oscillation, the very warm water in the Gulf of Alaska off the northwestern United States, western Canada. This cold water is a configuration that supports a particular climate pattern that has been very persistent, whether it was El Nino or La Nina. The atmosphere is very tidal. I think we know that. And the sea surface temperatures are one of the largest drivers of this tidality. And so we've come off of 3 years of an El Nino. It's going to take time for these warming ocean temperatures along the equatorial Pacific to have an impact on the weather. So depending on what type of El Nino we have, well, it's going to determine whether or not we have a colder than normal winter, which do happen in El Ninos, and I'll show those in a moment. The other key thing to look at is it doesn't get a lot of press, but there has been an increasing amount, well, it gets some press. The increasing meltwater from the Antarctic continent flowing northward has actually produced a very large area of cold water in the South Pacific region that is impacting the way that this El Nino is trying to develop. Because of the gyra, this colder water is headed to the equatorial region and is stunting the westward progression of the very warm upwelling. So this El Nino may not quite form the way that we originally thought. Another way of looking at it very quickly, El Nino, La Nina, I think most of us have this, the negative PDO, again, with the warmer temperatures in the Pacific North. Now, the Gulf of Alaska has warmed as well. And these are model variations versus the actual looking at the satellite imagery. Now, the classic El Nino, La Nina winter patterns. In El Nino, typically the jet stream is enhanced across the southern United States. La Nina, the convection is farther to the west. And in El Nino, the convective is farther to the east over the warm water. And this shifts the jet stream pattern. Again, I believe this probably is review for many of you. Now, ENSO forecasting. This is something that there are innumerable models now that are being run by the various international and national entities. On the left is the ENSO consolidated forecast out of the Climate Prediction Center that carries many different agencies, including the American Climate Forecast System version 2, which shows a very warm sea surface temperature anomaly expected as we get into midwinter, very similar to the Bureau of Meteorology forecast from the Australian model. But interestingly enough, those are the only two of the suite of models that are showing it to be that strong. The consensus for most of the models suggests a high-end weak, low-end moderate El Nino occurring over the course of the next winter season. And again, that has dramatic consequences potentially for how the weather actually occurs. Again, normally El Niños produce relatively warm, dry winters through the plains. That may not be the case, and it's something that I've been trying to figure out. There's also the alphabet soup. It's not just ENSO. There are many other signals that go on within the ocean atmosphere complex that drive the way that ENSO not only behaves and forms, but modulates the weather. Now, these are U.S. temperature distributions for every El Nino since 1950. I pulled a subset of these out because what's most noticeable is that in moderate El Ninos, which is the middle panel, there are several that, while you might expect warm in some years, some of the El Ninos that were fairly moderate in strength actually ended up having colder than normal temperatures through large parts of the plains. Some of the weaker El Ninos also, about 50% of the weak El Ninos, we will experience a normal or colder than normal winter. And a strong El Nino, should it eventually make it to the strong category of 1.5 degrees or greater net sea surface temperatures across the ENSO 3.4 region, that will very likely be warm and dry. I bring this up because, again, it's in question as to what will happen. Now, I heard Frayne mention about evapotranspiration, I believe, early on. There are models that are run on a regular basis by the National Weather Service where you can get access to your forecast reference ET. It's not quite the exact same as the regular evapotranspiration models that are available, but this is one that's run daily. It's available through the National Weather Service on the public webpage. If you look up the National Blend of Models, and you do a search for National Blend of Models, you will find a whole host of products that the Weather Service produces, including precipitation forecasts that are updated several times a day, and this forecast reference evapotranspiration for 7 days. So this is the one from this morning showing approximately 1.26 inches of fret over the course of the next week in the Northern Valley, and you can get an idea of what the model looks like. So something that may or may not be of interest to you. Precipitation and temperature-wise, we're in a relative cool spell right now. These are the 5-day temperature forecasts looking ahead, highs, lows. So we're essentially looking to be below normal as we get into the weekend. This is the Weather Prediction Center's 7-day total precipitation forecast. Obviously, ports of the Central Plains expected to get very heavy rain. Up into the soybean producing areas, looks to be getting more precipitation over the course of the next week as well as the pattern shifts. And we're going to see the large upper ridge. Remember, we've also got the southwestern monsoon is in effect, and you can see it by this plume of forecast precipitation up in western Mexico. That plume of moisture will be feeding showers and thunderstorms out into the plains, and a northwesterly flow, very much like in the winter, will be bringing a series of clipper-type systems to the region as we move forward. And that pattern may last through most of August. The 6 to 10-day outlooks that were issued yesterday reflect that below normal temperature pattern and above normal precipitation, especially through large portions of the plain, the Red River Valley being on the edge. The 8 to 14-day outlooks, these go into the 21st of August. And of course, these are updated daily as well. And then this is a relatively new product. If you're not familiar with it, the Weather Service is producing a week 3 and 4 outlook, the same motif as the 6 to 10 and 8 to 14-day outlooks. These are updated twice a week, I believe, the beginning of the week and late in the week. But they give you kind of a general sense. They're bridging the gap between the 8 to 14-day and the monthly outlooks. So a little handy tool to be considering looking at as well. Now, these are the Northern Hemisphere analog outlooks. And these are based on years where the current sea surface and atmospheric circulation projected into the future with a moderate El Nino being modified by the Pacific Decadal Oscillation and some of the other alphabet soups, the Atlantic Multi-Decadal Oscillation, we would expect to see across a large part of the region. These are August to October, October to December, December through March of 24. We would see a very large area of temperatures averaging on the cooler side of normal through this entire 3-month period. more normal temperature pattern as we get into the fall, into the beginning of the winter season, and kind of a bias towards perhaps a below normal temperature pattern through much of the plains into the Red River Valley. Now, again, this is based on a moderate El Nino being modulated by other signals in the atmosphere. Precipitation-wise, it looks to be relatively dry as we go through the fall. Then we start to see a shift towards more normal precipitation, still below normal through much of the grain belt region. But as we get into the winter season, into next spring, we may see the typical wet cycle in an El Nino that occurs here, the Ohio Valley, being shifted back west because of, again, the way that the global circulation will be modified by other forcings in the atmosphere aside from just ENSO. One of the big keys is something known as the Madden-Julian Oscillation. That is a large-scale oscillation in the Pacific that moves from north of Australia towards the western coast of South America on a regular basis. The other one is known as the quasi-biennial oscillation. Now, the quasi-biennial oscillation, or QBO, is also very well known within the climate world. That is a regular oscillation. Every 2 years, the very upper level winds above 10 millibars oscillate from westerly to easterly, We're roughly every 26 months. And when it goes into an easterly phase during an El Nino, this is the more likely scenario. And we are currently transitioning from a westerly to an easterly QBO. So as the QBO becomes more easterly, it'll very likely put an impact on the ENSO and result in something more El Nino-esque. Now, the Climate Prediction Center also runs a series of outlooks of soil moisture based on their model, particularly the Climate Forecast System version 2. That's the American model that runs out to, well, it runs out years in advance, but it's publicly available out to 1 year in advance on a regular basis. And it is also part of the international suite of models known as the International Climate Model Ensembles. So what this shows is dry soils in the deeper layers eventually being eased. And by the time we get into the late fall, early winter season, there could be a bit of a surplus of soil moisture once again over parts of the plains. Again, expecting a very El Nino-esque, La Nina-esque transition. Okay, so late summer into fall looks to feature normal temperature patterns and below normal precipitation with a transition to the cool side of normal, with normal precip during the fall based on the current forecast sea surface temperatures. Now, historic fall El Nino years that best represent the current and recent climate trends, typically would want to present a bias to warmer and drier than normal over the Red River Valley. This looks to be a moderate El Nino, and moderate event winters exhibit extreme variability. That's very common. As I say, some years are cold, some years are very warm. So many of the climate forecast models, both the US and the international models, predict a bend towards warmer and seasonally average fall precipitation and a warm winter, which is the most common output. I'm thinking we might see something very non-standard because of the quasi-biennial oscillation. I guess we'll talk next year and see how bad I was. That'll be one of my scores, Jenna. Coming out of the 2023 drought, looking for a little real amelioration expected, even if we have normal snowfalls. Again, we had second snowiest winter on record across parts of the Red River Valley and Northern Plains. We had virtually no significant river flooding this past spring because we had such excellent percolation because of the dry soils. The quasi-biennial oscillation, as I indicated, is forecast to turn negative, which is likely going to enhance the MJO. That Madden-Julian oscillation negatively impacts the El Nino by cooling sea surface temperatures, or at least mitigating the strength of the warmth. So we get greater variability, both in temperature and precipitation. So it's a real complex battle going on out there. Now, the national multi-member ensemble outlooks show a classic El Nino signal coming in as we move through the course of the next several months. Now, this is August 2023, shows it to be very warm. we're not starting off so warm. So when I look at this, I think, well, maybe the multi-member ensembles are struggling capturing what's actually going on out in the Pacific. And they show drier weather across the for the month of August, which may or may not materialize depending on how much precipitation we get. Looking farther ahead, August, September, October, these national multi-member ensembles, again, they're following the classic El Nino response with very warm temperatures over the northern plains and kind of a neutral precipitation pattern. October, November, December, start to see a little bit of the cooling that shows up as suggested part of long-term climatology. Again, there is no strong signal in precipitation showing up. The southeastern U.S. looks to be wet, and that's kind of a normal climate signal as well in a typical El Nino year, because the jet stream is typically enhanced as we start getting into the October, November to December timeframe. We start to see more storms coming out of the eastern Pacific and across the southern plains and then up the East Coast. Typically, El Nino winters are when the northeastern U.S. gets hammered with the really big snowstorms. And finally, December, January, February, this is the meteorological winter, showing the classic warm, kind of a bend towards drier than normal, perhaps, over parts of the plains. And again, I've got some serious doubts as to whether the national models are picking up on some of the things going on. Now, trends. I talked about trends earlier. Now, these are my composite models based on the trends. So if we were to follow the standard climate model trend pattern, we would see this October through December would be warm. Interestingly enough, the years with El Nino that fall out with all the other atmospheric signals matching up suggest warm and wet. So again, a very non-standard response forecast. What I'm going with more based on my local composites, this is also trends, looking ahead for the larger period, December through March, then getting into the late winter into very early spring. Still very warm, but a fairly large area of on the high side of normal precipitation. Can't take these values exactly, and they're in millimeters per day, so can't take them exactly at face value because this is a composite. But again, this would be if the trends dominate. And there's an old expression in climate forecasting, the trend is our friend. Well, that doesn't work out so much anymore. Remember how our temperature pattern is kind of flattened out? There's something else going on in the atmosphere. Now, detrending and just looking at the 2023-24 composite post-77 analog outlook, that's looking at the years post the last big change in the climate signal, would show perhaps on the warmer side of normal over Minnesota, colder than normal over North Dakota. But the good news, if it pans out, is a relatively wetter than normal pattern. This is non-trends adjusted. This is if the atmosphere responds in a non-standard way. And again, I'm leaning heavily on the quasi-biennial oscillation and Madden-Julian oscillation destructively interfering with a warm ENSO event. Now, the international climate outlooks, which are about to follow, are from the IRI. I'll go through these relatively quickly. They're also available online. This is a cooperative of numerous agencies across the world that produce multi-member models specifically designed for predicting droughts and such. That was the original intent. And they are available for use free of charge. Generally warm and dry weather is expected to dominate South America soybean areas into January 24. Much of China is currently wetter than normal, even though the long-term their drought shows up because of the way the SPI works. India warmer than median, wet north, dry south. A strong warm signal for Ukraine, Serbia, Croatia, Austria have been to cooler and drier most areas of eastern Ukraine this winter. The African continent is forecast to be quite warm most areas. And Australia, which has been very wet across the north and dry in the south, the El Nino is expected to basically flip that pattern. So this is just an example of the global standard precipitation evapotranspiration index, which is another way of looking at drought or wet areas in the United States as well as globally. Again, this is from the IRI, the International Research Institute, and all available online. You can see, of course, we're getting the massive wildfires in Canada because, well, they're in a serious drought. Australia, which is coming out of this wet cycle, will flip, and China, showing all the extreme wet weather that has gone on there, picking itself up in the SPEI map. Okay, South America, late winter or the late season outlooks, basically right on through January of 2024. They're forecast to be very warm over much of South America and very dry. Again, these are all the numerical outlooks from the IRI, which may be suffering from some impacts because of the non-standard ENSO, but these are what the models are showing. Asia, late summer into early winter, basically warmer than normal temperatures, starting to moderate a little bit to more normal in spots. Precipitation, we start to see moisture increasing across parts of the Eurasian continent as we get farther into the winter season. Europe, basically looking quite warm as we move through the October-December time period and get into January of 2024. And precipitation-wise, again, they're relatively dry in many areas. There may be some increase in precipitation, but it looks like relatively drier weather. The spotty showers across parts of the region, typical in the winter, is what the models seem to be suggesting. The Middle East, supposed to be extremely warm as we get into the January 24 timeframe. And the Mideast, fall, winter precipitation, again, classically in the spotty, and a lot of this is orographically driven depending on how the net flow flaws out. So, and one last, I think, Africa, looking at their temperature outlook, they're supposed to be unusually warm as we go into January of, that should have been 24, not 23, excuse me, and dry basically over parts of the equatorial region, south of the equator, in the enhanced jet band because of the expected ENSO event that would be wetter than normal. And Australia, they're going to flip from relatively cool to very warm and dry. So they'll be talking drought in Australia as we go through their meteorological spring and summer. So I threw a lot of stuff out there real quick. I know it's what I learned in the military. If you can't dazzle them with your brilliance, you baffle them with your... And so, but seriously, if you've got questions, please feel free to ask, and you can contact me at my at the email, or my phone numbers listed there, both my cell, and yes, I actually have a landline still. I'm that old.
Well, thank you, Mark. That was a lot of information, but I appreciate that, and the visuals are always very helpful. I don't see any questions coming through, and I've been watching them throughout to see if we get anything for Frayne or Bill or anybody else that presented today, but I haven't seen anything come through. So any last minute questions, feel free to come off mute and ask them if you'd like to, if you feel they're maybe a little too long to put in the chat, but I don't see anyone doing that. So Mark, I think you can stop sharing if you'd like, and we'll just kind of close out our morning. If anything comes up to anyone, feel free to interject. But what I want to say today is just thank you for joining us. Thanks to all of our speakers, especially for their input. We appreciate all of the discussion that you all contributed today. Speakers to this webinar. I want to remind everyone that's attending that today's seminar was funded by your soybean checkoff dollars. And with that, I'm going to close the session. And I wish you all a very successful growing season, a safe harvest. And as always, reach out to the Soybean Council in any way we can help you. This has been recorded today. It will be on our website, and you all will get an email notification when this hits the website. So with that, thanks again, and have a great week, everybody.